Thanks for tuning in to India Market Close. And you know, it's a pattern that we are now getting familiar with. The markets may start off in whichever way, but they build up strength. Look at the Nifty 50, a robust 1%, 25,500. The intraday would be very interesting to see here, simply because this is a day and we are trading at the high point of the day, wherein banks and IT are not outperforming the Nifty. So if you pull up the Nifty IT intraday, and if you pull up the Nifty banking intraday, you will see Nifty IT at the high point, yes, but it is flat. Banks 0.72%, and therefore the Nifty is doing its own thing without the two of the heaviest sectors participating. That's quite something really. The market breadth should come up on your screen next, and we'll get the mid cap and the small cap indices too. This is okay, not as great. So much unlike what we've seen in the last couple of days, today mid caps are underperforming the large caps, and even the small cap index is extremely flat. So let's focus on the winners on the Nifty 50 today. Let's get the heat map up on the screen. And NBFCs right up there: Shriram Finance, Jio Finance, Bajaj Finance. And JioFin and Bajaj Finance were at the high point from through the beginning. It is Shriram Finance which has made this very good intraday move. Adani Ports, Eternal, Axis Bank, Reliance is participating in a big way. We have HDFC Bank about 1.66% higher too. Adani Enterprises and some of the metal names are doing well. What's not doing well? Dr. Reddy's and Tech Mahindra. Can we get the weightages or the point contribution to the Nifty just to show you? I think RIL and HDFC Bank would be there, right there. HDFC Bank and RIL, but Bharti Airtel too contributing here. And this plus some of the others is the reason why the Nifty is outperforming the Bank Nifty and the Nifty IT in the session today. Plus not too many losers. I think that also in some sense helping the index behave well today. Broader markets, Mahima, are a bit quiet than what we are usually used to, but you don't complain when the Nifty is knocking on the doors of 25,500.
Almost, yeah. Yes, absolutely. And and we can make that out from the advanced decline ratio that we've seen. It's almost 1:1. So it's the pain is actually on the broader end of the spectrum. The counters like Jai Balaji, Apar Industries that are doing well, but in terms of Lloyd Engineering, it's up 8%, but some counters that are not doing well. There's Infibeam Avenues, which is down almost 16.8%. There's Factor, which is down 6% Endurance Tech down by about 5%. Sagar Chem, HLE, Glasgow, DCX Systems all down by about 4 to 3%. But counters that are doing well and keeping the broader end of the spectrum in check include counters like Lloyd Metals. Let's pull up that counter and see what it's doing in trade today. Jai Balaji up almost 11%. A lot of these counters doing well in trade today. Let's also pull up the overall sectoral heat map and see how sectors are faring in trade today and see what sectors are stealing the show for sure in the markets. There you go. There's Nifty Infra, which is up 1.5%. Oil and gas doing well today now that the crude prices have stabled, up 1.5%. Nifty Metal up 1.4%. Nifty Finance up 1.3% as well. But Nifty Realty lagging. Nifty Realty is always in convergence to where the markets are. It's down by about 1.3%. Media down 1.15%. So the profit booking seen there. Nifty Pharma down by about 0.09%. So that's with regards to where the sectors stand. But yes, speaking about the overall, over the total market and the BSE 500, if you can pull up that. Like I was saying, there's Balaji that's doing well. There's Apar Industries that's up 8%. Alok Industries up 5%. Tube Invest up 5% as well. Dalmia Bharat, Abort, Nesco as well as Awas Finances all seeing gains of about 3%. But that, let's also welcome in our guest for the day, Kush Bora, founder of kushbora.com, joining us now. Kush, good afternoon to you. Especially keeping the expiry in mind, what are you seeing? What are the levels that you are seeing on the Nifty 50 as well as the Bank Nifty?
Hi, Mahima. I think the expiry trade is done and dusted. Ever since the Nifty took out 25,350, I think that move was very surprising. We had a call condition around 25,300, then shifted to 25,400, and now 25,500 is staring as the highest OI contributor on the call side. Thankfully, even the put OI kept shifting higher, so that built that confidence. I think, as I said in the opening line, the expiry move is done and dusted. Even the PCR for Nifty right now stands at 1.34, which is suggesting that it's already in a bit of an overheated territory risk reward ratio. from now on might not really be favorable for a long trade. But that's only for the here and now and the today. I think from a medium term perspective, the index is shaping up beautifully. There was this resistance that we spoke about a lot of times, before this breakout at 25,250. That has been taken out with a gusto. I think this shifts the support levels to the higher side. Now that resistance of 25,250 will act as a support. So you should consider long positions on decline. But if you have a position long, you should continue to hold. I think the action will now shift to the mid and the small cap space, which is a little muted today. But if you recall our conversations about 15 sessions ago, which is these were overheated territories and had to see some profit booking. They did, and now they're back to their winning ways. Although because it's the monthly expiry, perhaps Nifty is the star of the show today. But I think there is a lot of action that is that will be seen in the coming days in the mid and the small cap space. So if you've missed it out on the last occasion, the last 2 months or so, the focus should now shift to the mid and the small cap space.
And what about the Bank Nifty, Kush?
Well, Bank Nifty, I still remain very constructive on, especially because, as we've been talking, HDFC Bank, ICICI Bank were at support zones and they've rebounded from there today also, as Neeraj was pointing out. They are some of the top contributors for the Bank Nifty. I think on the upside, 57, 700, 58, 500 are the next level to watch for, and 56,000 will now act as a support. The reason for that is while HDFC and ICICI have started doing their own thing and have started to move up, the PSU bank kicker that has come in is very encouraging. So as long as they hold ground, continue to even gain some ground on short covering moves, HDFC, ICICI, and even SBI turning a corner will actually take the Bank Nifty higher. So yes, you might see some consolidation because it's just close to the high point, all-time high points. But on the whole, the structure looks very bullish. If I were to create longs, I would still look at Bank Nifty for creating fresh longs. Any 300-400 points decline should be taken as an opportunity to go long on the Bank Nifty. So yes, a Bank Nifty also 57, 700, 58, 500 are the next levels to watch for on the Bank Nifty.
Kush, good afternoon. What about the ideas for this afternoon? I presume that they would be in the mid cap and the small cap space.
A little mixed, a little here, a little there.
Okay.
You can't ignore the large cap category as well. And since I missed out, hi Neeraj. HDFC Life, the stock continues to do very, very well. Even today on the expiry day, you're seeing the stock notch up gains. But this 800 mark, just because it's the expiry, is acting as a bit of a resistance. The overall trend in the sector, in fact, is rather encouraging. So some of the other names also doing well, but I've picked HDFC Life. 830 is the target, 780 is where you place the stop loss. Along with this, amongst the rate sensitives, the realty sector also doing well. And one name that stands out, at least for this week, has been Marathon Next Gen Realty. Very good moves on this one. Had a golden crossover 2 sessions ago. Volume action in the early part of this week was just staggering. So Marathon Next Gen for a positional bet of and targets of 660 and 685 with a stop loss around the 610 mark. Becomes a buy call.
The NBFCs, I mean, you're giving Marathon as well as HDFC Life, but the other NBFCs, JioFin, Bajaj Finance, Shyam Finance, they are really rip and roaring today. Is there more upside here, Kush?
So Bajaj Finance I will be a little skeptical on because, we've seen it rise and then perhaps been correct a little. Similarly for Shriram Finance, we've had this one move up, but when you look at the 700, 710 zone, becomes a bit of a resistance. But if you're willing to sort of overlook that, and by that I mean the time frame, if you're willing to give it slightly longer time frame, then yes, Shriram Finance makes the cut in my list. What I like more is the move on Jio. It had a stellar run, then an equally stellar downtick, but now it's taken out all resistances. It's moving higher. I think there is a significant upside to be had on Jio after the correction that it had witnessed. So for levels of 345, even 370 on the upside, with a stop loss around the 280 mark, there is a good chance that the momentum that started in Jio could continue. So I would pick Jio, Shriram Finance, and then Bajaj Finance in that order among the three. But yes, the likes of AB Capital, LTF, these are some of the names that you have to keep on your on your list.
Okay. Kush, anything on Brainbees that you're seeing? The stock is seeing a significant amount of spike today. Let's pull up that. It's up almost 13% as we speak. And it's been gaining throughout the day. Look at that chart. And this has been after, n number of sessions where it has seen a significant amount of pressure as well. What is your reading with respect to where charts are concerned for this?
In fact, not just today, Mahima. If I dial the clock back early June, there were about 2-3 sessions that I can see that had a big uptick on the back of very strong volumes, and on the way down that it slipped from those 425 odd levels. That was because of market volatility and on the back of very thin volume. So there is a very clear accumulation, on this stock around the 340, 370 zone. It's very close to that level even now. I think there is some accumulation that's happening. Maybe once we have the institutional holding data, we might get some more insights into this. But overall, it's looking like it's turning a corner. It's finding buyers at lower levels. So if I had a position, I would continue to hold. If I didn't, I wouldn't mind building one, because it's taken on the 20-day moving average today, the 50-day moving average today, along with the good volumes that you spoke of. On the way up, 410 and about 445 are the levels to look at, and the 20-day moving average, 50-day moving average rather, near 360. Which is also a support zone, should act as your stop loss.
Got it. Kush, stay on. The next conversation promises to be an interesting one. A recent and rather somber study by the National Housing Board showed it would take at least 109 years, even for the top 5% of the richest individuals in Mumbai, to talk about real estate per se. Imagine a flat in Mumbai costing 3 crore rupees, a price tag out of reach for many. What if you could own a piece of that property or even a stake in an entire building without the burden of managing it? I mean, in a simple way, that is where real estate investment trust or REITs come in, right? These trusts pool money from investors to buy and manage, or just manage, large-scale real estate spaces, from office towers to shopping malls, and even maybe in select cases, residential complexes. By investing in a REIT, you can earn a share of the rental income without dealing with the tenants, maintenance, or having to fork out the whole amount yourself, becoming a landlord without the headaches. So how can you leverage the power of a REIT? Should you or should you not diversify your portfolio with REITs? To answer these questions, I'm joined by Sharik Merchant. He's fund manager at White Oak Capital Mutual Fund and looks at this pocket very, very closely. Sharik, good having you. Thank you so much for taking time out. This is Neeraj here. Good afternoon.
Hi, Neeraj.
This was our simplistic version of talking about REITs. I would love for you to tell us, why is it that you guys at White Oak study REITs so closely? What is the investment case of REITs for institutional investors or retail investors?
Sure. So, Neeraj, I think you put it very beautifully when you started, giving an investor access to a piece of real estate, which typically a ticket size would be restrictive. What REITs provide investors is that you get access to the highest quality of grade A real estate by buying units of that real estate. Now, what is not always appreciated as well is that when you're looking at equities, let's say a company that is a developer, what that developer does is it buys land, it constructs the real estate, and if it's, let's say, commercial real estate, it will let it out and then enjoy the rentals. So it comes with a completely different level of risk profile, because there are several nuances and challenges associated with going through the entire cycle in developing real estate, besides the time itself. What a REIT does is that it takes on developed real estate. 80% of a REIT portfolio minimum is mandated by the regulation to be already developed and rent generating. So the risk profile, because it is largely let out real estate, it reduces an investor's risk profile and therefore enables someone to access high quality, professionally managed grade A real estate at a significantly lower level of risk. Now, this does not necessarily only mean commercial real estate. When we are talking about REITs, it also includes asset classes like malls, which have a completely different tenant profile, and the drivers for, say, commercial real estate versus mall real estate can be very different. So, from an investor's point of view, it gives you access to different levels or different types of income generating streams at different levels of risk profiles. And so, like you said, where does it fit into an investor's portfolio? The where it sits is somewhere between debt and equity, where we think of returns closer to equity like, but typically lower than equity, but at risk profiles that are significantly lower than equity. So your risk adjusted returns tend to be fairly healthy. So that's why, as an asset class, we really like REITs, and I think they're at a very, very nascent stage today. They're only going to grow meaningfully from here.
Hi, Sharik, hi, Mahima also joining in. Just want to understand as to what is your expectations as to how REIT markets will evolve in the next 3 to 5 odd years, and considering if a person wants to go ahead and invest in a REIT today, how much of a percentage in terms of his or her total portfolio should be REIT per se? Because we always say, right, that do not put all your eggs in one basket. What's your reading there?
Got it. So, from a growth point of view, maybe I'll point you to a few statements that large infrastructure players like Blackstone or Brookfield have recently made. There are commitments in India which are in the tune of $50 billion each. They want to double this portfolio over the next few years. These go into infrastructure assets, they'll go into InvITs, they'll go into REITs. And at some point, these assets will come into the market to public platforms, allowing smaller investors and other funds to be able to invest in them. The size of the assets today is roughly 1 lakh crores for REITs, slightly higher for InvITs. Over the next few years, we think that this sector will grow multifold in size as more and more assets can be REITified or can also come into InvIT structures. And there was a recent study that said that the pool of assets that are today available that can come into InvIT structures are close to 20 lakh crores. So that is the kind of potential that you're seeing of this sector over the next few years.
And that, sorry, you continue.
Yeah, and in terms of where this sits in an investor's portfolio, you're very right, or cannot put all eggs in one basket. This becomes a very effective tool to diversify portfolios. The traditional mindset has been to look at investments through an equity lens or a debt lens. But with REITs coming in, what this does is that it is giving you a completely different profile of income and risk assets that can add to your portfolio. Remember, till now, this asset class was just not available. Because you now have access to this asset class, you can think of this very differently in terms of how you want to allocate. There are again nuances to this. I don't think you should think of all REITs or all InvITs in one basket. They also within them come with very different levels of risk and return profiles. So within REITs and within InvITs, you have the ability to diversify.
Sharik, what within this landscape? I mean, because there are different kinds of REITs, right? Some manage malls, some manage commercial real estate, right? At some point of time, we'll have warehousing REITs as well. I'm pretty certain of it, if not already. So what, to your mind, which are the better ones for an investor to look at when they are looking at REITs? And what's the average return that one should anticipate? I mean, there are some people talking about 9% being good, but at a point of time, when the markets are a bit lower, even 12% was available as a yield, right? So can you fill us all of these gaps with?
Yeah, so like I said, there will be different risk and return profiles which you have to keep in mind. When you're thinking about commercial REITs, the underlying is commercial assets where your drivers will be how commercial real estate picks up in India. Essentially, how GCCs, which are the largest takers of grade A real estate in India, how GCCs grow in the country. When it comes to mall REITs, you're effectively taking a call on discretionary consumption in India growing. And as long as you believe that discretionary consumption in India will continue to grow, mall REITs become a very interesting play. Also, remember that there is very limited supply of high quality retail space in India. If as a brand who wants to expand, there is limited high streets. You need to go to malls. Where will you get top quality space? So the ability of malls to charge greater rentals is only growing. Similarly, even for commercial real estate, you will see that there is a very wide divergence between grade A spaces and grade B spaces. REITs, because they are professionally managed, have the ability to invest in capex within existing buildings. They uplift the quality of the building and therefore start to command premium rents.
Sharik, so here's my question. If somebody buys in into a REIT, any REIT structure which they might be comfortable with, let's assume after analysis, at a yield of maybe 10%, 11%, what have you, would you reckon over a period of 5, 7, 10 years, you earn that yield of 10, 11% plus the upgradation in the prices of property, and therefore a CAGR return of maybe 13, 15, 17%? I don't know what the number is. I'm just throwing numbers at you, but that kind of return could be possible?
Let me give you some perspective here. So today, for REITs, yields tend to be in the 6 to 7% ballpark. But remember, they are also very tax efficient. But what is underappreciated is the growth element. Typically in India, a lot of you may be aware, rentals escalate at 15% every 3 years. So these are contractual rental escalations. Over and above that, you have other levers like increasing occupancy, mark to market on the rentals, new assets that are coming into the REIT, either through M&A or where they have land available and they are constructing on that land. So these become growth drivers for REITs. So when you put all of it together, which is a combination of the yield that you're getting today, plus the growth that is associated with them, I would believe that a low to mid-teen number is where most REITs would sit. Or to put it in different words, to create a benchmark relative to equity, I would suggest that it would be marginally lower than what equity returns would be.
Sharik, just wanted to get a sense of how these are tax efficient, because if I'm not wrong, there are three sources of income through which REITs generate income. That's rental, capital gains, as well as dividend income, and all three of them are taxed differently, if I'm not wrong. So how are they tax efficient? Just wanted to understand that.
Right. So I'll explain all three of those components. When it comes to equity dividend payouts, dividends are taxed at your maximum marginal rate. So you're paying full tax on that dividend. In the case of REITs, the dividend component of the payout is fully exempt to the taxpayer. The second component is the interest component, which is fully taxable, comparable to dividends of equity. And the third component is a component called return of capital. Now, in return of capital, what is done is that the payout that is received by you is reduced from your cost of acquisition. And then at the point at which you sell the REIT unit, you will pay capital gains on that amount. So you defer your tax liability and you reduce it at a lower rate, because capital gains in India are charged at a lower rate than your maximum marginal rate of tax. So net, the overall REIT investment tends to become more tax efficient than typical equities.
Got it. Sharik, lovely talking to you. Thanks for giving us this, what some people might call a primer, but it's always good to revisit what REITs exactly do, because for a lot of people, this subject is not as well discovered. So thank you so much for giving us a lowdown on this.
Yeah, thank you for having me.
Now, viewers, remember, I can't ask Sharik about this, but because he's on the buy side, but the names of the companies which offer this REIT structure, and there are 3 or 4. So there is Embassy Office Parks REITs, that is one. There is Mindspace Business Parks REIT. There is there is Nexus Select Trust, and there is Brookfield India. And the returns thus far, I mean, I guess this is what this is since listing. Okay,
Yeah,
since
since
listing.
listing.
Is this
Yeah.
XIR? No.
Like,
It has to be since listing. 24% XIR would be quite strong,
Okay.
I would suspect. So
yeah.
must be since listing. But okay. Okay, we need to hit a break maybe. Actually, no, we'll take a break. But just before that break, Kush Bora is with us. Kush, since we're on this topic, there's a 3 or 4 listed ones. Do they come up in the charts at all as a steady gainer? The 3 or 4 names that I spoke about?
Yeah, to be completely honest, not that I track them very closely, but the one that's standing out, from the names that you've mentioned is Mindspace Business Park REITs. A very steady up move, very linear kind of an up move. Of course, some volatility here and there, but on the whole, if you see, this has been one of the more steady ones. So, yeah, I mean, if someone wants to consider, that this is one perhaps that, you could put on your list. Also, it's seen some cooling off in the last 2 weeks. So that this dip also might act like a healthy, entry point. The other ones that you mentioned have also given a good gains, as that table was suggesting, but have had their fair share of volatility. So if I were to pick, then I would actually look at the Mindspace Business Park REIT, because of the sheer nature of the stability of the upward that is.
Okay, we need to slip into a quick break. Kush, stay on. So much more to talk about. Back with Heard on the Street and then more stock idea.
Sambhav Steel Tubes Limited now proposes an initial public offering of its equity shares. The 100% book built offer is being offered at a price band of Rs 77 to Rs 82 per equity share of face value of Rs 10 each. Offer opens on Wednesday, June 25th, 2025. Offer closes on Friday, June 27th, 2025. For risk involved and other details, please refer to the red herring prospectus dated June 19th, 2025, which is available on the website of the company, the SEBI, the BRLMs and the stock exchanges.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks,
Do I buy Ola?
Should I hold ICICI for the long term?
buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Sambhav Steel Tubes Limited now proposes an initial public offering of its equity shares. The 100% book built offer is being offered at a price band of Rs 77 to Rs 82 per equity share of face value of Rs 10 each. Offer opens on Wednesday, June 25th, 2025. Offer closes on Friday, June 27th, 2025. For risk involved and other details, please refer to the red herring prospectus dated June 19th, 2025, which is available on the website of the company, the SEBI, the BRLMs and the stock exchanges.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Day's high for a clutch of things, including the Nifty 25512 and led by heavyweights. HDFC Bank is participating all right. In the points contribution, it was anyways number one. Now I think it's done even better, 1.85% higher. This is turning out to be a terrific afternoon of trade, and much like the last couple of days, it builds up as things move up. Now, what's being heard on the street? Does HDFC Bank or Reliance or ICICI Bank feature there? Does Bharti feature, or is there a completely different set of stocks? Let's get in Somit to talk about all the chatter. This Somit, it's very interesting because Bank Nifty is not the top contributor today.
Right.
But NBFCs and HDFC Bank are right up there in the percentage gains or the points. Anything on these first?
Bajaj Finance is one of the top gainers, and maybe that could be the reason why financial index is one of the top contributors and not the banking names.
Yeah.
Both finance and FinServ both are gaining up in trade.
And GeoFin is up, and Shriram Finance is up 3%.
Right.
Yeah. But anything on HDFC Bank, by the way? Anything?
No, just normal flows that are
normal
coming
flows.
in. Yeah.
Okay, fine. What's on the chatted loose menu today?
Completely different set of stocks. Firstly, it's UPL. Now, it's one of the top losers in FNO if you look at. Now, dealers are indicating that there's a buzz on the street that there could be some potential write-offs related to its Brazil subsidiary, and that's the reason why the stock has been declining in trade. At one point of time, it was down as much as 3%. Second stock, again, one of the top FNO losers, that was Colgate. Dealers are indicating that there's a rumor on the street that the Q1 could be much weaker than what the street was anticipating, and that's the reason the stock has been declining. But dealers are also saying that at these lower levels, there are a few large HNIs that have been accumulating this counter. So keep an eye out for Colgate. There could be a reversal is what dealers are indicating going forward. Tata Steel is one stock. The stock has gained on the back of fact that Citi recently upgraded China's GDP forecast, and that's the reason why all metal stocks have been gaining. Tata Steel also is up around 1.5% in trade, but dealers are indicating that there are sell flows at higher levels, given the fact that there is some expectation of steel price cut that could come in anytime soon. For Aditya Birla Sun Life AMC, dealers are indicating that there are buy flows on institutional desks. Both FI and DIs have been accumulating this counter at lower levels. The AUM growth for Aditya Birla Sun Life AMC is expected to be much better than its peers, and that is one of the reasons here. And lastly, Syrma SGS, the buzz on the street is that the company might announce an important acquisition anytime soon. So keep an eye out for Syrma as well in trade.
Okay, interesting set of names, Somit. Thanks. And some stocks on which you got to be careful as well. So bear that in mind. By the way, what are since you spoke about flows in HDFC Bank, etc., there is also this Nifty quarterly rejig, right? What are flows going to suggest?
So the Nifty quarterly rejig was announced some time while back, but the flows regarding those changes are expected to come in tomorrow in trade, most likely in the last half an hour. Few stocks that I'll mention based on the highest inflow is ICICI Bank. Inflows of around $128 million is expected to come in, followed by NTPC around $126 million of inflow. Then there is Kotak Mahindra Bank, Bajaj Finance, Bajaj Finserv, HDFC Life. These stocks could see inflow of anywhere between $75 to $91 million. So keep an eye out for these stocks. These are the top 6 stocks based on the inflows. The top 6 stocks based on outflow, first on the list is Bharat Electronics. $85 million of outflows is expected, followed by M&M, $81 million. Eternal, that is Zomato, Sun Pharma, Tech Mahindra and HCL Tech are expected to see an outflow of anywhere between $66 to $69 million. These are top 6 based on top 6 stocks based out of outflow. There are many other stocks, but keep an eye out for these stocks because the inflow and outflow amount is much higher than what other stocks are showing.
Very interesting. But on a day when maybe there is an expectation of an outflow, Eternal seems to be doing well. So that is actually zooming in trade. So on the expected inflows or otherwise, Bajaj Finance, etc. Okay, but Eternal is an interesting one. Okay, Sumit, thanks for that. And Chakri Lokpriya joins in as well, and it would be lovely to get him in because he's got his great eye on NBFCs and banks as well. Remember, Kush is already constructive on the non-lending one, which is HDFC Life, but some of the lending names are doing really well. So focus on that for a bit. Chakri, to you first, and then Kush will take in a technical view maybe on HDFC Bank. But Chakri, to you first.
Good afternoon.
Big zooming
thanks for
here.
having me.
No, the pleasure is ours. What do you do with the financials?
So what we do is basically, I think, buy more of Shriram Finance, Geo Financials, MMM Financials. We are in an interest rate cycle which RBI has helped you by cutting rates 100 points, pushed in liquidity, cut down the norms. So all these are and as a result of all this, cost of lending for these NBFCs will also come down a little bit. And so now it's all the incentive is there for the bank to lend, creating an environment to buy, borrow by the corporate lenders and as well as consumers. So even home loans have come down, interest rates that is. So both corporate and consumer lending should pick up at this point in the cycle.
Chakri, hi, Mahima also joining in. Soumit was mentioning about Colgate, and what he was saying is that Q1 is expected to be lower in terms of volume as well as top line growth as to what the street was expecting. I remember after the Q4 numbers, there were a lot of brokerages that had upgraded the counter, also had anti-consensus buy on Colgate. Your view with respect to this counter?
Usually whenever the monsoon is good, they'll say, why don't you go and buy some more Colgate, but I would stay away because there hasn't been much of a product innovation, and how many times more in a day would you brush? So there is no volume growth also. So against that backdrop, they have to get only new customers, and that pace has been very slow. So I think, with the valuations up there, we'll stay away from Colgate.
Anything on the real estate side of things, because we always have seen that if the market is going up, there's real estate which is always lagging, the Nifty Realty especially. Anything in that space that you're liking, Chakri?
But the environment is right for real estate as a sector, simply because, interest rates have come. The same reasons that we discussed for NBFCs. When interest rates come down, EMIs come down for the borrowers, both existing borrowers and new borrowers. So both of them benefit, and that creates an incentive to go out and think of purchasing an apartment, across price points. And so this pipeline for, name it Prestige, Shobha, DLF. You saw DLF selling out, such a big amount in just a matter of days. That is real demand. So I think the environment for them and the valuations are all right, despite running up. So those are the names I would buy.
If we can pull up the Nifty Realty chart once again, there's only one gainer today, that is Phoenix Mills. Otherwise, all of the other counters are seeing pressure today. Sobha down 3%, Prestige, Brigade, as well as Macrotech, all seeing pressure down by about 2%. Kush, anything on Wockhardt? Wockhardt is also seeing profit bookings today. It's down by about almost 4%. What are the charts indicating, and what's the support and resistance that you're seeing?
So very interesting moves on this one. I mean, it's not listed in the F&O space, so hasn't really got much to do with the expiry that's playing out. But even before today, you see after the stock hit that 1850 mark, it's been under a gradual profit booking mode. In fact, the volumes on the way down also, select days have been rather high. So I think this is perhaps that extended round of profit booking. Almost on an immediate basis, a support for this one comes in at 1600, a round figure, at that. So if it does halt, the downfall around those levels, then, it might just, pause and then make a bump up again. But if not, then, the lower levels of about 1450 could also be tested. So yes, it went up also rather sharply, seeing some profit booking. 1600 is the key level to watch for on the downside.
Okay, so that's with regards to where charts are concerned for Wockhardt. Now, the Mumbai Urban Transport Project is reportedly planning to splurge 30,000 crore rupees on buying train sets. Anushi has details of which companies could actually benefit from this. Anushi, what are you picking up?
Railway sector remains in focus now, and again, now this is on a 30,000 crore of an order opportunity, is why we are seeing some of these railway counters in focus. Now, what is happening for FY26 is in contrast to what happened in FY25. Now, if you look at FY24 to 25 picture, the order inflows were on the muted side, but FY26 presents an exciting opportunity with order inflow of around 30,000 crore. So this is a strong outlook that we are seeing in comparison with almost a muted sort of a picture in FY24 to 25. Now, Mumbai over here presents a 30,000 crore of an opportunity. And this is why the Mumbai Urban Transport Project. Now, what exactly does this project of Phase 3 entail? It includes 5th and 6th line between Virar and Borivali, 4th line between Kalyan Badlapur and Kalyan Asagaon. And this pertains to procurement of more than 200 train sets with about 2,856 air-conditioned one-day metro coaches. Now, what's new about this rolling stock order that we are seeing is that these 238 trains being procured in form of Vande Bharat train sets and includes maintenance of around 35 years. If you look at the expected timelines for this big set of order that we are looking at, the expected tender will be released in August 25 of this year. Final bids and tenders will be placed in March 2026, while tender award to the lowest bidder is expected by September of 26, and coaches would then be rolled out starting H2 of FY28. So key contenders, or rather the key stocks in focus over here, include the BEML and Titagarh Rail in the listed space that we are seeing for India. While other stocks in focus also includes BHEL and Siemens India in terms of where the propulsion systems are concerned. Now, in terms of the outlook forward for the rail companies, now shortage of wheel sets had impacted the wagon production in FY25. So that is expected to normalize from mid-June onwards. Along with that, large tenders are expected in the second half of FY26 post the absence of significant orders as specified earlier, and management is also optimistic of several of these companies on regaining revenue growth momentum, but margin recovery would remain on the slower side. So this is the overall picture that we are building for the railway sector.
Right, Anushi, thank you so much for giving us all those details. Chakri, I'll come to you on this one. What she was indicating was that in FY25 there was muted order inflows, but FY26 is where order inflows have picked up for a lot of these railway counters. Anything in specific that you're liking in the space where valuations are looking attractive to you?
The space is looking good, and Titagarh Wagons, for instance, valuations are still okay. The companies, look at the company's order book. And no other company, as in other sectors, wouldn't have that kind of visibility for next 5 years in terms of revenue. And the company trades at about 30 odd times for a revenue EPS growth of north of 30 odd times. And the company is expanding right from metro to Vande Bharat to export and ancillary services, which are higher margin. So these kind of opportunities for the railway sector did not exist about 3, 4, 5 years ago. So now they have actually become a growth sector. So I would buy, I think there's sufficient upside in, for instance, at Titagarh Wagon or Bharat Earth Movers. They make the earth moving equipment very necessary for a part of this railway line. Plus, they are also used in infra. So that's another name which looks also very good.
Okay. Kush Bora, come in on these. Also come in on what is happening with HDFC Bank. Would you go out and buy it at these levels?
So, Neeraj, I think, about a week or two ago when we were discussing that, I'm more confident on Bank Nifty versus the Nifty. I think the confidence came from the fact that HDFC Bank, even ICICI Bank for that matter, were at strong support zones and due for a rebound. Crossing 2000 is a very, very healthy sign for this one. So as Chakri also mentioned, I would say buy more. Not a bad idea to keep accumulating this, especially if you get a dip towards the 1975, 1980 mark. This is from a trading perspective. But if you have, you should continue to hold. I think this is a multi-year breakout that HDFC Bank is giving. So this move is very likely here to stay. If I had a position, I would hold on, and the next key level to watch for would be 2100, 2175 zones. So yes, continue holding on to HDFC Bank. You could actually look at adding ICICI Bank. It's still some distance away from the recent highs that it made around the 1465 mark. So there could be a catch-up play that might come in. Now, as far as the railway names go, yes, Titagarh Wagon is shaping up rather well. The resistance comes in at 1000, which is also quite a distance away. So if you wanted to play, then you should look at Titagarh. Exmaco, JSW, they've made good moves. At least Exmaco has, but it's giving up gains. So I would be a little watchful from a near-term perspective, but Titagarh is setting up beautifully. And the two stocks that were mentioned in that report, BHEL and Siemens, incidentally, I like both of them. They've had a good run and they've actually weathered the storm of volatility that was there over the last 2 weeks and are again looking to move up. So Titagarh, from the railway particularly, HDFC Bank, a buy or a hold, and keep an eye out for BHEL and Siemens. Both are poised for a big up move in the coming months.
Okay, so that's the view with regards to where these railway counters stand. All right, now shares of one MobiKwik Systems are in the spotlight today, surging as much as 15%. Let's pull up the chart and see. It's cooled off from its day's highs, of course, but trading 9% higher as we speak. And this is after a large institutional investor exited the company through a block deal. We have Harsh joining in with more details on this.
Yeah, large block on this one. Thanks for that, Mahima. Large block on this one. What we're seeing is likely a full exit by an investor. But let's talk a little bit about what possibly has transpired since the morning. 8% shares have changed hands since the morning. So we've seen a large block. Volumes are at 59 times 30-day average. And it's hit a 2-week high as well. At the very top, in fact, it's the biggest intraday gain at the very top. I did mention that in the last 3 months. So 15% is what it was gaining. 281 was the day's high. It was up 15% intraday at the very top. Now let's talk about the investor which was supposed to exit. The offer size was around 62.1 lakh shares, which comprises an 8% stake. In terms of who the investor was, Net1 Applied Tech Netherlands, which is a Netherlands based private equity, or rather a private equity having invested via Netherlands, has offloaded its entire stake of 8%. So it's a full exit, it's a cleanup trade, and which is why you're seeing the reaction that you're seeing. The floor price was set at 225, likely done at that price or higher, and we'll obviously have to wait and watch as to how much was sold and who are the buyers. That will obviously come later today evening, and we'll get that perspective. But one more thing that you need to be mindful about. Stock is trading below the IPO price, and therefore valuations not particularly expensive in relative terms to the IPO. 1 month returns have been flat, 6 month the stock is down 58%. All-time high to the current point, 61% lower. And from the all-time low, the stock is up 19%. So maybe some bit of that also playing on investor minds.
Yeah, but up 19% after the 9% up move today. So in some sense, there is more, it's disappointed investors more than it's rewarded investors. So keep that in mind. But Harsh, thank you so much for that whole piece around one MobiKwik Systems. This and many others, which are the unique financial services plays, if you will. And unique as in it's not mainstream financial play, but doing a few interesting things. Chakri Lokpriya, from a swath of these companies, is there something that stood out for you?
Geo Financials is doing lots of new things, right? It's the things which the regular banking industry hasn't done with success.
Chakri, sorry, are you saying JM Financial or you say Geo Financial?
Geo Financials.
Okay, please continue. Yes.
Yeah. So whether it's digital banking, insurance, UPI payments, the whole space, this is for the new India, the emerging India. Now that class of the middle class of investor Indians are, the number is expanding. And, here's a company which is all focused on that. It's still in its early stages. But I think we would give credit for the fact that they've created such a big platform on where there holds huge potential.
Okay, so that's the view with regards to where these companies stand now. Kush, anything that you're seeing on HLE Glasscoat? It's down by about 3.6 odd % today. Trying to pull that up. If you can pull up the chart for 1 week as well for this counter and see how it's done. It's down about 3.6 odd %. Till we try to pull that up, Kush, what's your view with regards to where charts are concerned for this counter?
Not a bad move, Mahima. It's down about 3.5%, but in the last 4 sessions, it had a good run from 418, 419 odd levels, all up all the way up until 480. So it did make that smart up move, and negative divergences were setting up. In fact, if you dial the clock a little, March, this stock was languishing near the 200 to 20 mark. So more than 100% gains already in the last 4 or 5 months. So some cooling off, par for the course. If this in fact continues, and the stock does dip to the 425 to about 435 zone again, then it will be a good entry point for anyone who's missed out on the rally last time around. So I think this is just regular profit booking more than anything else. Volumes also aren't really something to write home about, which is a good sign. So on the way down, the volume hasn't really perked up as much. So you could well continue to hold if you have a holding. For fresh entries, look to 425, 435 zone as a fresh entry point.
Okay, so that's with regards to where HLE Glasgow is concerned. The other counter that's been buzzing since yesterday is KNR Construction. Chakri, it was buzzing yesterday because of the huge order win, 4,000 plus crore order win for this particular counter. Today also, if you can pull up the counter, okay, it's cooled off from its day's heights. It's down almost 1% as we speak. So some profit booking seen there. But when I was seeing the volumes as well, it's almost 12 times its 30-day average today. The Bloomberg consensus estimates, when I was checking that, there were around 6 odd buys and 7 odd sells for this counter, and the return potential was also in negative. But what's your view with regards to KNR Construction?
KNR Constructions and the construction companies in general, their growth rate has come down due to various reasons. Both awarding of contracts has come down, the margins in the business has come down, and well-known problems of land acquisition and the cost of acquisition has gone up. I think, these are some of the problems which require a robust government intervention to clear it all up, including as an adjacent, if you look at NHAI construction, road construction numbers have come down quite a lot in the last 1, 2, 3 years. So I think that needs to change, and they need a lot more order wins for the stock and this whole sector space to move up.
Okay, okay, so that's with regards to where KNR Construction is concerned. Now, the outlook for the Indian cement sector is turning positive, with Nuvama expecting a pickup in demand and improving pricing power for companies. Let's bring in Puneet to give us more perspective on this and a complete breakdown as to what Nuvama is saying.
Well, thank you for that. So it's definitely been a very active space, the cement one, because post the price increases in April as well as May, it's a heartening sign that the prices have largely actually remained stable in June, which is actually a weak period for the cement companies going into Q2 as well. Nuvama has also mentioned that the sustainability of the prices will be a key monitorable going forward, but they feel like the demand is likely to pick up in FY26, which will be aided by the traction in capex after a very weak FY25 which was impacted because of elections amongst other reasons. What's also interesting is the capex from the central government. Now in FY23 as well as 24, we saw 20% growth in each of those respective years, which actually fell to 11% in FY25. Now, at the start of FY26, it's actually started in a very healthy manner. In April, the capex was up 61% on a YOY basis, and that's just for the month of April. So we could expect the demand momentum going forward. When you look at the capex for this year by the government, it's roughly about 11 lakh crores, 11.2 lakh crores, and the number of 61% YOY growth in April signifies that within the first month itself, we've actually done a capex of 1.6 lakh crore, which will benefit the cement majors as well. The other aspect is the state government capex, and that's also actually picked up 8% on a YOY basis in the month of April, so another key positive there as well. Finally, in terms of what's the outlook and which cement sector stock should you have on your radar, Nomura had a very interesting note on 5th of June, and the key aspect that they mentioned is they're bullish on the long-term tailwinds of the sector and have preferred large caps compared to the medium-term mid-cap players. They see a higher volume growth of 7% CAGR, which is much higher than the 4% CAGR which we saw in the past decade. So all signals pointing to growth. They prefer Ambuja, Ultratech as well as Shree Cement and Ramco Cement as one of the top picks. But in terms of Bloomberg consensus also, we saw stocks like Ultratech, which have 81% buy calls from analysts, and both ACC and Ambuja have more than 70% buy calls. So all signals translating to growth, and the stocks reacting on news flows as well as pricing largely being stable in the month of June.
Okay, thank you so much, Puneet, for breaking that down for us. Chakri, the interesting part in that note was government capex picking up and at almost 61% YOY basis. Because of this, of course, cement space is what they're mentioning will see growth going ahead. But do you think that following that, paints will also see some boost?
Absolutely, yes. And, I think ACC, Ambuja, Ultratech are extremely well placed in this whole. Now, even after the 7% growth, we have to recognize that it only matches kind of the GDP growth number. GDP grows at about 6-7%. So, which is still way below the growth rates that the cement sector used to grow if you rewind back sufficiently in the past. For various reasons, it's slowed down infrastructure spending, and that is clearly with the interest rate cuts and liquidity, etc., that RBI has done, is going to receive a boost. And the valuations are very, very reasonable, whether it's ACC, Ambuja, or Ultratech. And clearly, these are the companies which have the pricing power and would be buyers.
And anything in the paint space that you're liking, Chakri?
Paint space, I think I'll continue to stay away. They're good trades, but so whenever we find a trade, we will, but otherwise I'll stay away.
Stay away from paints. And Kush, your view with respect to where charts are concerned for the cement space, anything that you're liking there?
So Ultratech's a very clear winner on this one, no two ways about it. So from fundamental and technical lens, Ultratech stands out. And yes, on the way up, you are looking at about 12,300, 12,700 as the next legs, of the up move. 11,600, the 50 DMA is the support zone. Add to that, Ramco Cement, it had a wild move today, moved all the way up until 298 and then has corrected significantly. The volumes are very high on this one. So yes, Ultratech and Ramco, and a short covering candidate, I would have Ambuja Cement. It has been under pressure for some time, but for the last 4 sessions, it's seen a big up move and holding above some of the key averages, 20, 200, 50-day moving average, all of those conquered in the last 2 sessions. So as a short covering and a catch-up play, I think Ambuja must also be on your radar. So Ultratech, Ramco, and Ambuja, 3 stocks to watch for.
A lot of high flyers, by the way. And keep in mind as we hit that break that Bikaji Foods is picking up. Nuvama is at the day's highs. SAIL has inched up too. So 4.5%. I wonder if SAIL is a late mover. Yes, it is. 4% higher now. So doing very well. And Brainbees, Jai Balaji, Apar top the list on the Nifty 500. The broader markets may be quiet, but individual stocks are on a rampage. We take a break. Up next, more news and updates. Kush Boraj, take a moment to thank you for joining in today. Really appreciate your time. We'll get you some top buy today, sell tomorrow ideas and fresh technical views as well. Stay tuned.
Sambhav Steel Tubes Limited now proposes an initial public offering of its equity shares. The 100% book built offer is being offered at a price band of ₹77 to ₹82 per equity share or face value of ₹10 each. Offer opens on Wednesday, June 25th, 2025. Offer closes on Friday, June 27th, 2025. For risk involved and other details, please refer to the red herring prospectus dated June 19th, 2025, which is available on the website of the company, the SEBI, the BRLMs and the stock exchanges.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Sambhav Steel Tubes Limited now proposes an initial public offering of its equity shares. The 100% book built offer is being offered at a price band of ₹77 to ₹82 per equity share or face value of ₹10 each. Offer opens on Wednesday, June 25th, 2025. Offer closes on Friday, June 27th, 2025. For risk involved and other details, please refer to the red herring prospectus dated June 19th, 2025, which is available on the website of the company, the SEBI, the BRLMs and the stock exchanges.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India. Back with India market close right here on NDTV Profit, 1.17% higher and strong. It is looking to be a very strong market, and if you're a Nifty trader on the long side, you wouldn't have any complaints whatsoever. European markets are starting off okay. DAX is up about 0.8%. Not starting off, they're behaving okay, is the point I'm trying to make. So keep that in mind. And the US futures are also ticked higher as the S&P 500 is nearing new records. So no complaints whatsoever across the world markets. Rajesh Palvia, SVP Technical and Derivatives Research at Axis Johnson in that light. Rajesh, you couldn't have chosen a better time to join in because the markets are rip and roaring. Are you initiating fresh longs via plain vanilla futures or via options?
Good afternoon, Neeraj. Good afternoon, everyone. So yes, markets are roaring, and we are comfortably above 25,500. That's the level where we were keeping eye. So now looking at the index move, especially in expiry trade day, I think if we close about 25,500, I think this really may extend to 25,800 also. Bank Nifty is at all-time high trajectory. So possible target for Bank Nifty, we may see towards 57,500, 600 zone comfortably in next 1 or 2 trading session itself. So both indices are looking positive only. For Nifty. Yes, we are playing with the option. Now we are buying 25,600 call option of 3rd July. That is on our buying side buy side trade on the index. Because the kind of short covering which we are witnessing at this juncture is clearly giving us confidence that 25,800 we may achieve in short span of time. So we are buying 25,500 600 call option, which is now trading at around 170 odd level. So this call option one can buy for upside target of 260 or 270 kind of level. On the downside, stop loss should be placed at around 125 rupees.
Okay. Your picks for the day, Rajesh?
So 2 stock ideas. First one is Eternal, a very strong breakout after a brief consolidation, and stock managed to give breakout of previous swing high. Looking at the formation which we are seeing on the daily chart, it's a rounding bottom formation is taking place, and looking at the structure, we believe that now this stock has potential to move towards 300 kind of level also. But for trading point of view, one can buy this stock for target of 280. At this juncture, keep stop loss of 260 to buy Eternal. The second stock is from the metal space, that is Hindalco. A very strong rally in most of the metal stocks, especially in last 1 hour of trade. The way Hindalco managed to give breakout on a weekly as well as on the daily chart, it clearly indicates that now this stock can cross 700 level also, and positionally 730, 740 would be the target. But for trading point of view, 715 one can project as a target for trading. Keep stop loss towards 678 to buy Hindalco.
Eternal and Hindalco are the 2 picks that Rajesh has given today. Can we try to pull up Eternal's 1-week chart and see? Because it's been slowly and steadily rising. Let's pull up that. It's up 2.8% as we speak right now. But on a 1 month and also at its day's high right now, there you go. That's the 1 month chart, and that's the 1 week chart, and that's the kind of moves that we've seen on Eternal. Of course, there is one overhang on the chart, that is your FIs might see some selling there because of the company caping the FI inflow in the counter, but we'll have to wait and watch out for that. But strong moves on Eternal for sure. Now it's time for our bull and bear segment. Ask Automotive is the stock in focus today, especially on the back of a joint venture with Germany's TD Holding. While bulls expect the JV and government's ABS mandate to be huge growth driver, bears are skeptical about timelines. Puneet is here joining us and breaking that down for us. Puneet, what are you picking up?
Well, thank you for that. So definitely stock is reacting to positive news flows of a new joint venture that's largely with Germany's TD Holdings. This will be focusing on high electronics, high value vehicle electronics specifically, as well as interior system, and that's the premium margin product which Ask Automotive is going into. That's the first bull case for us. While they've not given timelines, generally the JVs in the previous timelines will have taken a little while to scale up to meaningful growth. But nonetheless, it's a positive news flow. Another product intervention that the company has done where they were absent. It's important to know that this is company's fifth joint venture over the last 12 to 18 months and incorporating some of those positive aspects. And over the last 3 years as well, the company has been looking to enter new growth areas and agencies which have been absent largely in the past. So tie-ups as well as product innovations is definitely something that's visible now. The second one is, of course, the mandatory ABS ruling. Now, this came on on June 20th, where media reports are speculating that from April of 2026, we could see anti-lock braking system coming in across two-wheelers. Now, just to give some context, roughly India sells about almost 1.5 to 1.75 crores two-wheelers in 1 year. Almost 80% of that is entry-level bikes. So this could be a huge product boost, and companies like Endurance as well as Ask Automotive already have existing anti-lock braking system products. So it could be a huge product benefit for an already developed product. So the other players might need to do tech tie-ups as well. So it could take some time. The effect, although coming in April, will only have effects in FY27. And finally, in terms of valuation, stock is not cheap by any means. That's 28 times FY27 price to earnings. But the growth that the company has been showing has been much higher than the industry. So investors could give it that premium. But we have seen the niche auto players like Gabriel as well as something like a Subaru's get that higher P rating, the P re-rating essentially. So it has lacked peers in that aspect, but definitely mandatory ABS as well as a new joint venture could propel a next level of growth for Ask Automotive.
Okay. Thank you so much, Puneet, for giving us all those details on Ask Automotive. Chakri, I was just trying to pull the P that it's currently trading at, and the 12 months trailing P here is showing me around 40 times, and FY27 forward P also at 28 times, which is not looking cheap, as Puneet rightly mentioned. What's your view with regards to where Ask Automotive stands?
These companies are all fast-growing companies, and so if you look forward, and so at 28 times, and if you look 1 year forward, it'll look even more reasonable. And because there are new joint ventures which are coming on board, and these joint ventures will take time and short amount of time because electronics will translate into revenue soon. So I would not look at the valuation, and valuations are okay in the context of growth.
Okay, Rajesh, on the charts, Ask Automotive, last 1 month, it's seen gains of about 80-odd%. What are the supports and resistance that you're seeing?
So fresh breakout on this stock, and looking at the breakout, I think if it continues to trade above 505, there is a possibility that we may see further higher level towards 535 to 540 in the continuation of this up move. So at this juncture, those who have already bought can trail stop loss towards 500 level, hold the position for upside target of 540.
Okay, so that's the view with regards to where charts are concerned for Ask Automotive. Now, let's shift focus to the IT space. Citi has come out with a report on Tech Mahindra, maintaining a sell call while highlighting macro uncertainties that may impact revenue trajectory. My colleague Puneet is still with us, breaking that down for us. Puneet, what are you picking up?
Well, thank you for that, Mahima. So definitely it's a sell rating on Tech Mahindra, and that's largely penciling in the weaker macro environment going on for the IT sector. Now, they've said that while the management remains very focused on 15% EBIT margins by FY27, it could be something to watch out for, because for FY25, they reported EBIT margins of 9.7%. So it's a steep growth that's anticipated in the 2 years, where the macro uncertainty has seemed to be risen. So that will be one of the key things to watch out for. The other key aspect is that the revenue trajectory has seen some impact according to Citi. They've said that it could have more impact on discretionary spends as well going forward, which could put the revenue targets in picture as well. Finally, they've said that valuations at 28 times currently FY26 as well as 23 times for next year also looks to be largely penciling in a lot of growth that's expected to come. So it seems to be priced in according to Surinder Goyal of Citi, and hence maintaining a sell on Tech Mahindra. Within the IT space, they only have Hexaware as a buy call. So that's another interesting point. But for Tech Mahindra, largely penciling in the growth that's expected to come over the next 8 quarters.
Okay, thank you, Puneet, for breaking that down for us. Chakri, any view on Tech Mahindra and any counters that right now you're liking in the IT space? I'm sure that a lot of analysts have come out and said that they are staying away from this space. But anything in the mid-cap space maybe that you're liking?
Even in the front cap, in the front line, whether it's an HCL Tech, I think we are okay with the stock. We understand that, discretionary spends, IT spends are still weak, will remain weak at least for the next quarter or two. But valuations have kind of corrected. Now, the same story applies to Persistent, mid-cap, but of course, a far more expensive stock, valuation-wise, but also growing much faster. And Tech Mahindra, we'd stay away for the reasons which Puneet just explained. And, this is not going to translate into revenue anytime soon, which is a further drag.
What is also buzzing for the last couple of days is MCX. Now, likely the UBS note, which led to this excitement. They've given a target of 10,000, but more importantly, they are saying that the monthly MOM numbers or QOQ numbers might look very strong as well. Viewers remember the note from yesterday. It was amongst the top brokerage pieces that we highlighted here on the channel. And that stock is doing really well, 8835 now. Rajesh, if you went long on this one earlier, yesterday or last week or etc., would you take money off the table, or are the charts looking strong for more?
Charts are still showing strength, and the way stock has moved up despite of this much of rally in very short span of time, still buying interest is there. Clearly, open interest is intact in this counter. I think maybe stock can extend its gain towards 9,000 plus level in the continuation of this up move. So I think hold the position would be the strategy. Trailing of stop loss towards 8650 would be the right strategy to ride this rally. It's uncharted territory for the stock, and the way the fresh renewed buying interest has been emerged in this counter, especially in last couple of days, that clearly shows that possible target beyond 9,000, 9,200 we may see in the short period of time itself.
Well, Chakri, what do you do with some of these? Exchange names, right? NSE in the unlisted space, but the valuations that MCX is trading at, BSE is trading at, would you invest afresh into them?
Yeah, NSE, I guess the valuation is still at a discount to the BSE. But, coming to MCX, basically, the world has now come to a very volatile situation in terms of commodities. Commodity demand is high, but there is a huge amount of uncertainty given the tariffs. And therefore, that leads to volatility, which is good for an exchange. And so against this backdrop, clearly that I would be a buyer of MCX.
Okay, so that's the view with regards to where these exchanges are concerned. Let's pull up the Nifty Bank because it's trading at its all-time high, and this is after 13 sessions is what I'm understanding. It's up 1% as we speak. So I think now it's echoing the returns of Nifty 50 as well. Can we pull up that and see where Nifty 50 is trading at? And Nifty Bank hits a fresh record high, and it's up third day in a row as well. There you go, almost in line with where the Nifty 50 is. Let's also pull up the constituents, in fact, on the Bank Nifty and see what are the counters that are pulling up the entire counter. There you go. There's HDFC, of course, the heavyweight. There's Axis Bank, there's AU Small Finance Bank and ICICI Bank, all up in green. The only counters that are kind of languishing is SBI, IDFC First and Fed Bank, but good moves in terms of where the Nifty Bank is concerned. Now, other counter which is in focus today is Nykaa. The stock is not doing much though. Let's pull up the counter and see where it is trading at its day's high point, up 1.17%. But this is after its investor presentation came in today, and of course, the investor day meet was also held today. I think the clear standout point for me from the presentation was that they've now come out and said and have given a timeline for the fashion business to see a break even in terms of their EBITDA, and they've said that they will achieve break even EBITDA by FY26. What they've also said is that they're aiming to grow at mid 20% levels every year by FY30. They plan to expand to 500 stores, almost double their stores by FY30. The ambition is to also grow their organic portfolio at 30% CAGR to 6,000 crore in terms of their gross merchandise value. Plus, the ambition is also to grow by 3 to 4 times in terms of their Nykaa fashion business. Women's segment is there to retain its dominance, but men and kids wear will also become prominent going ahead. Plus, marketing efficiencies will improve with scale going forward, which has already happened for beauty, and now the same thing will happen for the fashion business as well. Like I said, they're expecting break even by FY26, and beyond that, by FY28, they're expecting a mid to high single digit EBITDA, and by FY30, the target is to reach 10% of EBITDA margins. Lastly, they've also said that they'll grow 3 times through geographic expansion for Nykaa Superstore as well. So that's with regards to where key takeaways are concerned for Nykaa. Chakri, your view on Nykaa, how are you liking the business? I mean, are you interested in the business at all? And if yes, do you think that the kind of growth that they have kind of laid down for FY30, is that growth achievable for them?
Nykaa is in a space where the growth of, online affordable fashion is seeing a very upswing, across men and women's wear in India and outside India. And that will continue, and more so in an aspirational class in India is expanding very fast. So against that backdrop, I think, some of their near-term targets growth, they will hit. But for 2030, whether they can sustain that level of growth is a bit difficult for me to see from here.
Okay, and Rajesh, on the charts, Nykaa, how is it looking?
Looking at the short-term behavior of the stock, stock is in recovery track, and now stock is poised for giving breakout of its previous swing high, which was formed around 208 kind of level. So I think any move about 208 would attract furthermore buying interest in this counter. Strength is clearly visible as stock is trading about to all its near-term, short-term moving averages. So I think a possible target towards 220, 225 we may see for Nykaa in the continuation of this up move. So those who have already bought the stock can hold the position. Near-term breakout is suggesting that we may see 225 target. Keep stop loss towards 202 to hold the position.
Okay, so that's with regards to the charts for Nykaa. Now, fertilizer firms are under pressure as China has halted supplies to India for the past 2 months. With sowing season round the corner, this is turning out to be a big dampener. Varsha has more details with regards to this. Varsha, what are you picking up?
Yeah, absolutely. So you see all the fertilizers are under pressure. Even the sector is under pressure because, as you rightly said, that China has halted specialty fertilizer shipments to India for 2 months. Now the consignment of water soluble, slow release and micronutrient fertilizers are stuck. Now why this is important? Because these are vital for India's fruit, vegetable and horticulture crops, and India imports 80% of the specialty fertilizers from China, though there is no official ban, but China has used inspection and procedural delays as an excuse. Now how this is going to impact on India, because the fertilizer disruption could impact crop yields in the June to December planting season, and India typically imports 150,000 to 160,000 of tons during this period. Domestic production of these fertilizers as of now is limited. All top fertilizer companies, you take name of Deepak Fertilizers, Paradeep Phosphates or Nagarjuna Fertilizer company, all these companies operate in this segment. How is India's response and what's the outlook ahead? So Indian companies are now considering local manufacturing, but of course this is going to take time because we are heavily import reliant. India is exploring alternative sources like Jordan and Europe. However, logistical delays with new sources remain a concern. And lastly, if you see, Indian government till now has not yet made an official statement on the fertilizer halt, but because of this, the halt in the specialty fertilizers will of course impact the yields, which is a negative for farmers and the overall sector as well.
Okay, Varsha, thank you so much for that. Chakri, quickly your take on these fertilizer companies?
I would stay away because there's too much uncertainty. There's a political angle, there's a government subsidy angle, the earnings are not good. So I'll stay away from the sector.
Okay, thank you for that answer, Chakri. Rajesh, quickly, your picks for the day. What would you go ahead and buy?
For BTST point of view, I think Titan is looking very promising. Cup and handle formation breakout is there on the daily chart. Looking at the breakout, we believe that Titan may extend its gain. Possible target towards 3750, 3780 we may see for BTST point of view. So Titan is buy with stop loss of 3640.
Okay, Titan it is, and keep an eye out for Titan. I wonder if it's the jewelry angle or it's the retail angle out here, because some of the retail stocks have done very, very well too. Remember, Trent is a case in point. As the last few days has not had too bad. Today may be quiet, but otherwise has been okay. Speaking of what to buy and where to put money in a conversation with Nilesh Shah, founder of Envision Capital, who explained his outlook on both the defense as well as the IT sector. While he sees defense as a long-term bet, he feels IT is poised for some hurdles going ahead. Let's listen to a snippet of that conversation.
Defense rally, one could basically argue that it's done with because there's been a sharp up move. So to that extent, and yet, yes, there's been the start of order inflows, but it's not yet as much to basically warrant the valuations in the very short term. A lot of stocks are already beginning to trade between 50 to 100 times trailing earnings. So to that extent, and then there's been a sharp up move of between 50% to 100% from the lows that we saw in February, March. So probably in the very short term, it seems to be done. But clearly, I would think of defense being more a decadal story. I think the whole need to kind of spend on defense and then to kind of back that up with a huge bout of indigenization, which means to procure locally from domestic firms. I think that's basically a very, very long-term growth driver for our defense and aerospace companies.
Is that a rally you managed to catch, Nilesh? Because, we speak to people and some, managed to get it in time and some didn't.
Honestly, it's always dil mange more. You never have enough when things go well. And like as George Soros says, when you get it right, you better get it right big time. So honestly, yes, not to the extent one would have wanted.
Okay, Nilesh, the other question is when Nandan Nilekani says that it is amongst the most challenging times for the business, you stand up and take notice, right? What did you make of what Nandan is saying? What did you make of your own conversations with maybe your portfolio companies or global companies and your readings? I mean, how does Indian IT fare over the next 12, 18, 24 months in such a fast changing landscape?
So, I would tend to agree with, Nandan's views in terms of what he thinks about what's really happening in the global business landscape or the global economic landscape. The global economic landscape stands truly challenged. And somebody like Nandan, who's essentially looked at, the era from the 1990s onwards, where we basically began that era by saying the world is truly flat. Okay, from that now getting into that there is now increasingly deglobalization, countries are behaving in terms of silos. So I probably think his statement is more in the backdrop of that no longer is it now easy to conduct trade on a global basis, number one. Number two is I think purely from a technology point of view, and I would probably say that most businesses which are more world facing or global facing, I think I have to kind of deal with lower growth, slower growth, especially in a relative context where the domestic economy seems to be doing a lot better than the global GDP. And two is we have pockets like CAPEX, infra, defense, railways, domestic consumption, premiumization, all of those as businesses are growing in double digits versus global businesses growing in low single digit. And that creates a headwind for the larger Indian IT companies. I think the larger Indian companies have been growing in single digits for maybe the last decade or so, especially when the world was a lot more benign place, versus that the next decade doesn't seem to be as benign as what the last decade has been. So to that extent, I think for the larger IT companies, they truly have a challenge in terms of sustaining growth. And second is essentially the whole wave of AI which is coming in, which is driving the world towards more automation and all of those kind of things. And that can make it even more challenging for the bigger IT companies. And therefore, within the world of IT, probably the smaller IT companies, which are more focused, more niche, are becoming specialists in AI implementation. They probably will do a lot better versus their peers, versus their larger peers.
Okay, so that was Nilesh talking about how large IT firms could face challenges in the near-term future. Rajesh, some volume buzzers that I'm seeing, right now, and this has been the case throughout the day. Something like a Gabriel India, how is that faring on charts?
So there was some profit taking at a higher level, but still the way stock is now comfortably holding about 20-day moving average. So I think the way stock has shown buying interest since last couple of days, breakout is there on near-term chart. So 650 is the key level to watch for. If it continues to trade above 650, then we may see another round of rally in this counter. Possible up move can be there towards 690, even 700 level.
Power Industries? Apar Industries is the counter, Rajesh.
Okay.
It's trading 5 times its 30 days average volumes.
Yeah. So there is a breakout of last 5-week consolidation range, and looking at the breakout, the next target for the stock towards 8900, we may see in the short-term perspective. At this juncture, yes, one can initiate buy also, and those who are already holding can hold the position. Stop loss should be placed at around 8500. Possible really 8900 would be there.
Nifty Metal is the clear gainer in terms of sectoral picture. It's up 2.24%. Can we pull up the constituents on the Nifty Metal and see what's buzzing there exactly, and see what counters are kind of leading to that gain? There's only one counter in the red. There's Hindustan Copper doing well, SAIL doing well, Vedanta also doing well in trade today. Chakri, anything in the metal space that you're bullish on?
Hindustan Copper, copper is huge demand worldwide, huge shortage, and the volumes will just continue to go up. So, and other than that, I think Tata Steel, for all its problems, still looks okay.
Okay, and the Nifty Oil and Gas is also up and about in trade today, up 2%. Let's also try to pull constituents on the Nifty Oil and Gas and see what are the kind of moves that we're seeing. It's up almost 2% at its day's high point. Let's try to pull up.
Reliance, right?
It has to be Reliance. Let's pull up that. And there you go. A lot of counters buzzing there. All of these counters seeing good gains. Rajesh, anything on the charts that you are seeing, especially for Reliance? What's the kind of support and resistance you're seeing there?
So very strong rally in Reliance, and the way stock is now almost approaching to 1500 level, I think this momentum may extend further. 1540, 1560 would be the next target at this juncture. 1470 should be your stop loss to carry the position for Reliance. And from the same pocket, I think Hind Petro is also giving a breakout. So this stock also can be looked at for near-term trading perspective. 440, 450 would be the next target. Stop loss is placed at around 410.
Actually, pretty interesting that HP, BP, IOC are all doing so well. Chakri, there's a trade happening when people are going into standalone refiners, moving out of OMCs. That's obviously reversed now. But at these valuations, do OMCs make sense fundamentally? And which one out of the three?
I'd rather buy Reliance Industries for its refining business because of so much uncertainty with the HP, BP sales.
Okay, Chakri and Rajesh, thank you so much for joining us and giving us all those insights on NDTV Profit. With that, let's see as to what levels we are closing the markets at today. Let's pull up the Nifty 50 at its day's high point for sure. closing at 25,543, highest levels of the day, up 1.18%. The Nifty Bank also closing 1% higher at those 57,000 levels. The Sensex also trading 1.2% higher. Let's try to pull up the advanced decline ratio, because that chart will be an interesting one to watch out for. There you go. The chart has been an interesting one today, but the broader end of the spectrum is where the pain is right now. Let's pull up the mid-cap 150 and 250 to see that. There you go. The mid-cap 150 still, of course, closing at day's high point, up 0.5%. The small-cap 250 is also closing around 0.25% higher. So that's with regards to where these benchmarks and broader markets are concerned. But let's also pull up the Nifty 50 heat map and see what counters did well today. Shriram Finance, Jio Finance, Bajaj Finance. All these NBFCs doing well in trade today, closing almost 3% higher for all of these three counters. There's Bharti Airtel, Tata Steel, Eternal closing 2.5% higher. Hindalco also, Bajaj Finserv, NTPC all closing about 2% higher. A lot of these counters seeing gains of about 2% Something that's not done well, Dr. Reddy's down by about 1.5% and Tech Mahindra on the back of the City Note down by about 1%, followed by Wipro as well as M&M and Hero Motocorp. Let's also pull up the sectoral heat map quickly and see what sectors have done. Nifty Metal, the top gainer, up 2%, followed by Nifty Oil and Gas, Nifty Infra, Nifty Finance, and something that's not done well is Nifty Realty. Always the one that's moving against the market moves, down by about 1%, followed by Nifty Media, where profit booking was seen, and Nifty IT slightly lower, down by about 0.2%. Let's also pull up the BSE 500 and quickly take a look at how overall the counters have fared. Infibeam closing 16% lower, Endurance 5% lower, HLE Glasscoat 3% lower, and followed by AID Parry, AID Parry seeing profit bookings today in fact. Coromandel International, Network 18 seeing cuts of about 3% but counters that have done well and in fact seen well. Apar Industries up 8.5%, Tube Investment up 5%, Hindustan Copper, Abbott India, Dalmia Bharat, Bikaji Foods as well as Godfrey Phillips seeing gains of about 4%. But what has actually aided this kind of market rally? Let's take a look as to what the reasons are. Nifty trades above the 25,500 mark, gaining more than around 1% for the day, gains of around 1.13%. Nifty and Sensex gain for the third consecutive day in a row. Benchmark indices outperformed broader market indices. Overall, Shriram Finance and Jio Financial Services are the top gainers, seeing gains of over 3% each. Nifty Metal becomes the top gaining sector for the day for sure. Hindustan Copper and SAIL are the top gainers on the Nifty Metal today. Nifty companies added around 2.3 lakh crore in the market cap overall in today's gain. Let's also take a look at as to what are the cues to watch out for in trade post-market hours. Let's try to pull that up and see as to what are the things that you will most certainly watch out for. There you go. There's US GDP growth rate that will come in, that data will come in, US unemployment claims, Japan unemployment rate as well as Nifty reject flows. That's something to keep your eye out on the counters that will see these flows. In terms of corporate action, counters that will be trading ex-dividend, there's Allied Blenders, RPG Life, Jayant Agro as well as Bajaj Finserv to keep your eye out on. In terms of some more names in terms of trading ex-dividend, there's Bajaj Holdings, Maha Scooters, Care Rating as well as Cipla. Lastly, in terms of shares that will see exit in terms of lock-in tomorrow, there's Ventive Hospitality which will see lock-in of about 12% in terms of exit, Dam Capital 38%, that's a significant one, 38% there, and Translate Lighting about 58.1%. This one is most certainly the biggest one to see exit in terms of lock-in. But with that, we're completely out of time on this edition of India Market Close, but do stay tuned to NDTV Profit for more news and updates on the other side.
Sambhav Steel Tubes Limited now proposes an initial public offering of its equity shares. The 100% book built offer is being offered at a price band of Rs 77 to Rs 82 per equity share of face value of Rs 10 each. Offer opens on Wednesday, June 25th, 2025. Offer closes on Friday, June 27th, 2025. For risk involved and other details, please refer to the red herring prospectus dated June 19th, 2025, which is available on the website of the company, the SEBI, the BRLMs and the stock exchanges.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola? Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Sambhav Steel Tubes Limited now proposes an initial public offering of its equity shares. The 100% book built offer is being offered at a price band of rupees 77 to rupees 82 per equity share of face value of rupees 10 each. Offer opens on Wednesday, June 25th, 2025. Offer closes on Friday, June 27th, 2025. For risk involved and other details, please refer to the red herring prospectus dated June 19th, 2025, which is available on the website of the company, the SEBI, the BRLMs and the stock exchanges.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Hello and welcome. You're watching Market Express and I'm your host Himakshi Bahugna. Now let's get straight to the show, viewers. Bulls roared on Dalal Street with the Nifty topping 25,550 levels and the Sensex adding 1,000 points. Markets managed to scale a 9-month peak in today's session. Nifty up 2.8% in June series. NSE adds 4.2 lakh crore in the market cap today. On the other hand, NSE large caps adds 2.98 lakh crore rupees in the market cap. Now it was a good day for banks. Heavyweight HDFC Bank shares hit a record high of 2008 rupee apiece. HDFC Bank shares have now extended gains for the third straight session. This comes as its subsidiary HDB Financial Services see decent investor interest for its 12,500 IPO. Meanwhile, all sectors barring defense, realty and IT end in the green. Metal, finance and FMCG lead the gains. Autos were also in the fast lane today. The second day of HDB Financial Services 12,500 crore rupees initial public offering has seen the portion reserved for non-institutional investors being fully subscribed. The overall issue has also been subscribed 75% so far, with the portion earmarked for retail investors seeing a subscription of close to 53%. The portion reserved for existing employees of HDB Financial has received 2.68 times subscription. State Bank of India is set to raise 25,000 crore rupees through QIP, its first equity fundraise in 7 years, to bolster its Tier 1 capital, currently at 12.11%. SBI, with a market cap of 7.14 lakh crore rupees, has appointed Citi, HSBC, ICICI Securities, Kotak Capital, Morgan Stanley and SBI Capital as book runners. Meanwhile, Union Bank of India plans to raise 6,000 crore rupees split equally between equity and bonds, including 2,000 crore rupees in 81 bonds and 1,000 crore rupees in tier 2 bonds. With a capital to risk assets ratio of 18%, Union Bank actually aims to strengthen its 1.1 lakh crore rupee market cap. Citi maintains a sell rating. They've also cut the target price to 990 rupees from 1,040. Now the brokerage cites an adequately penetrated Canadian GLP-1 market. Citi also projects $750 to $780 million EBITDA drag from declining GREV limit sales and reduced PLI incentives. Despite challenges, Citi adds Dr. Reddy's to its Pan-Asia focused list, noting its strategic positioning. Citi actually continues to recommend selling Tech Mahindra shares, setting a target price of 1,430 rupees. The company stays focused on reaching a 15% profit margin by FY27. However, revenue growth slows due to global uncertainty and lower extra spending by the clients. Valuation remains high, with future gains already expected in the stock price. Nestle India's board approves its first ever bonus share issue after 1996 in a 1:1 ratio. Shareholders will get one free share for every share they own, with shares credited by or before August 25, 2025. Now, 25th or 2025. Now, the bonus shares will come from the company's retained earnings. Share capital will also double post issue, and the record date is yet to be announced. The bonus plan needs shareholder approval as well. Nykaa aims for mid 20% revenue growth, targeting 500 stores by FY30. Its organic portfolio is set to grow at a 30% CAGR, reaching 6,000 crore GMV. Nykaa Fashion eyes 3 to 4 times growth in 5 years, with women's segment leading. While men's and kids segments gain traction, marketing efficiencies will improve, mirroring beauty's success. Fashion is expected to break even by FY26, achieve mid to high single-digit EBITDA by FY28, and hit 10% EBITDA margin by FY30. Unilever, through its promoter Hindustan Unilever Limited, is set to sell a 61.9%, that is equal to 62% approximately, stake in the Quality Walls to Magnum Holdco, marking a significant shift in India's ice cream market. Magnum has signed a share purchase agreement with Unilever, with Quality Walls intellectual property set to transfer to the company. Now, this move will allow Quality Walls to leverage Magnum's brand and innovation expertise. Following the acquisition, Magnum Holdco plans to launch an open offer for Quality Walls public shareholders, complying with SEBI regulations. China has paused sending key fertilizers to India for 2 months. Now, these fertilizers help grow fruits, vegetables, and other crops. With sowing season starting soon, Indian farmers may face problems. India depends on China for 80% of these special fertilizers. Local production is low, and finding new suppliers like Jordan and Europe takes time. The Indian government has not made an official comment yet. India's railway sector expects a strong FY26 after slow orders in FY24 to 25. The Mumbai Urban Transport Project Phase 3 brings a 30,000 crore order opportunity. It actually includes new train lines and over 200 Vande Metro train sets. The tender process, to begin by August 2025, with final orders by September 2026. Coach deliveries will start in the second half of FY28. Key bidders include BEML, Titagarh, CAF, and Stodler. Texmaco Rail and Engineering has secured a major international order worth 535 crore rupees from Cameroon-based Camelco SA. Now, the contract includes manufacture and supply of 560 open top wagons valued at 282 crore rupees, along with a 20-year long-term maintenance agreement worth 253 crore rupees. The wagon supply will be executed in 2 phases over the next 24 months. Also, the deal includes a provision for an extra 1,040 wagons and their maintenance over the next 5 years, potentially expanding the contract scope and value. Lloyds Metals gets environmental clearance to raise its iron ore mining capacity to 55 million tons per year. This makes it the biggest iron ore mine in India. The move will boost raw material supply for steel makers and help reduce costs. The company will start with 26 MTPA of hematite ore and later include 45 metric tons of banded hematite quartzite. Now, a beneficiation plant is also being planned to improve ore quality. Dilip Bilcon announces the completion of the 4-lane Bangalore-Chennai Expressway sector in Andhra Pradesh. The project is now fit for commercial operation as of May 9. This major infrastructure development was executed at a bid cost of 1,060 crore rupees. The new expressway is actually expected to significantly improve connectivity and reduce travel time between Bengaluru and Chennai, boosting trade and commerce in the region. Tyre maker SIAT announces plans to raise up to 500 crore rupees through unsecured non-convertible debentures with a tenure not exceeding 5 years. These funds will be used for capital expenditure, refinancing high-cost debt and working capital needs. This issuance adds to the existing 250 crore rupees in the NCDs already raised. Additionally, SIAT will also infuse 400 crore rupees into its wholly owned subsidiary Sri Lankan SIAT OHT Lanka to support its acquisition of the Camso brands of highway tyre business. Now, the company's board also approves a credit facility of up to 1,000 crore rupees for business purposes. Ask Automotive joins hands with Germany's TD Holding GmbH, entering into a joint venture to manufacture, market and sell sunroof control cables and helix cables for passenger vehicles. The Indian auto components maker will hold a 49% stake in the JV, committing an investment of 2.45 crore rupees with an initial infusion of 49 lakhs at incorporation. TD Holding GmbH will hold the remaining 51% stake. Canfin Homes has received board approval to raise 10,000 crore rupees through debt instruments, including bonds and non-convertible debentures, both onshore and offshore. Also, the company plans to raise 1,000 crore rupees via qualified institutional placement or rights issue, subject to shareholder approval at the upcoming AGM. For the financial year 2025, Canfin Homes reported revenues of 3,878 crore rupees with healthy margins of 28%. Western Carriers India has secured a significant 558 crore rupees logistics contract from Jindal Stainless Limited. The 3-year agreement covers the dispatch of slabs, coils and sheet plates in DSO containers to multiple destinations across India. This prestigious mandate reinforces Western Carriers' expertise in managing large-scale mission-critical logistics operations for the manufacturing and metal sector. JSW Steel has filed a review petition in the Supreme Court challenging the May 2nd, 2025 order that rejected its resolution plan for Bhushan Power and Steel Limited and directed the company's liquidation. The Supreme Court had ruled that JSW Steel's acquisition violated key provisions of the Insolvency and Bankruptcy Code, now citing procedural lapses and delays. Following the judgment, the court stayed liquidation proceedings on May 26, pending the review petitions filed by JSW Steel and several lenders. The Supreme Court is set to reconsider the case after its summer recess, reopening on July 14th. Co-founders of PB Fintech, Yashish Daya and Alok Bansal, have announced plans to sell a combined 1.1% stake in the company. The shares will be sold at 1,800 rupees per share, representing a 2.2% discount to the current market price, valuing the transactions at approximately 912 crore rupees. As of March 31st, the co-founders together held a 5.7% stake in PB Fintech. This partial stake sale is seen as a strategic move by the founders and is likely to provide liquidity while maintaining a significant holding in the company. MobiKwik shares jump after a major investor sells off their 8% stake in a block deal, sparking strong market interest. The discounted sale pushes the stock to a 2-week high, with volume soaring. Despite the buzz, the stock continues to trade well below its past highs, and it also becomes the stock of the day.
Before we get you a snapshot of some key NDTV Profit exclusive, let's revisit some important commentary from earlier today. Mark Mobius, co-founder of Mobius Capital Partners, offers a fresh take on portfolio allocation. He advises investing 50% in equities to tap into long-term growth, while suggesting 10% exposure to gold as a hedge against market volatility. He also recommends 20% in property, reflecting confidence in real estate's steady value. Defense is the sector to watch, says Nilesh Shah of Envision Capital, calling it a decadal story. He remains bullish on both defense and railways for the long haul, even if near-term rallies may falter. Shah suggests buying defense on dips, while cautioning that large IT firms could also struggle to maintain growth going forward. SEBI fines BSE 25 lakh rupees for sharing key market data early with its own team and some paid clients. This happened in 98 out of 100 cases studied. SEBI also finds BSE failed to properly monitor client code changes and broker error accounts. These gaps could let brokers misuse the system to favor certain clients. BSE claims it made no profit and has fixed the issues, but SEBI disagrees and calls the lapses serious. The NSE is nearing its long-awaited IPO with SEBI no objection certificate expected within 2 months. Following NSE's 1,400 crore rupees settlement offer to resolve pending cases, sources tell NDTV Profit that NSE aims to file its draft red herring prospectus by December, targeting a potential listing in FY27. Now, the settlement, one of India's largest, addresses allegations of unfair trading advantages. With legal hurdles clearing, investor excitement is growing. SEBI's approval hinges on final reviews, paving the way for what could be India's biggest public issue, with NSE's market cap nearing 5.7 lakh crore rupees. Aditya Birla Capital's money management arm was hit by a cyber attack, leading to the unauthorized sale of digital gold worth nearly 2 crore rupees from over 400 customer accounts. The company says all affected holdings were quickly restored and fund transfers were frozen to prevent further damage. An investigation is underway, and the firm is working with cyber insurance partners, law enforcement to trace those behind the attack and strengthen security. Jaiprakash Associates, the flagship of the JP Group, has received financial bids from 6 potential buyers, including the Adani Group, Vedanta, Dalmia Group, Jindal Steel and Power, PNC Infratech, and Suraksha Asset Reconstruction. The company owes over 57,000 crore rupees to lenders like the SBI, PNB, ICICI Bank, IDBI Bank, and the National Asset Reconstruction Company. Sources to NDTV Profit say that if the offers aren't strong enough, creditors may sell the assets separately to recover dues. SMS Pharmaceuticals Telangana facility clears its 7th SFDA inspection. The plant, with a 120 kiloliter capacity for niche small volume molecules, strengthens its compliance track record. The company is targeting 20% revenue and EBITDA growth by FY26, backed by backward integration and 250 crore capex plan over 18 months. Now, part of the expansion will also support contract manufacturing operations. Infosys co-founder and chairman Nandan M. Nilekani described the current global climate as a time of uncertainty, unlike any witnessed in the recent times. The remarks reflect turbulent mix of geopolitical tensions, economic volatility, rapid AI disruption, and shifting trade dynamics that are challenging industries across the board. The Indian cement sector is setting up for a strong rebound. Prices stayed stable across regions in June, a positive signal, says Nuvama, which expects demand to pick up in FY26 on the back of rising capex. Nomura stays bullish too, and pointing to long-term volume growth and cost efficiencies. Large cap names like Ultratech, Ambuja, and ACC remain the top brokerage picks. India's UPI digital payment system is gaining global recognition, with the International Monetary Fund, or the IMF, strongly praising its success. A new paper from the IMF says that UPI has completely changed how people pay digitally in India. It points out that UPI's ability to work across different apps makes it easier for users and helps more people adopt digital payments. The IMF also suggests that other countries wanting to move away from cash should follow India's full approach. Defense Minister Rajnath Singh refused to sign the Shanghai Cooperation Organization joint statement after attempts to remove references to the Pahalgam terror attack while including Balochistan incidents. Addressing the summit, the defense minister strongly condemned cross-border terrorism, criticizing nations using it as state policy and providing safe havens. He urged SCO to address these double standards and has reaffirmed India's zero tolerance for terrorism. In a significant development regarding the Air India flight AI-171 crash, investigators have successfully downloaded data from the aircraft's black boxes. The government confirmed that data from both the cockpit voice recorder and flight data recorder has been retrieved. A multidisciplinary team from the Aircraft Accident Investigation Bureau is now analyzing this data. This marks a major step in understanding the final moments of the flight and determining the cause of the tragic incident. For the first time ever, Maharashtra's state electricity tariffs are set to be reduced. The Maharashtra Electricity Regulatory Commission has approved the state power company's MSEDCL's proposal to cut rates. Chief Minister Devendra Fadnavis announced on X that tariffs will drop by 10% in the first year, with total 26% reduction planned over 5 years. However, these cuts will not apply to tariffs charged by private power providers. 2 people have been killed and 11 are missing after an 18-seater bus plunged into the Alaknanda River in Rudraprayag district. The accident occurred in the Goldir area where the bus reportedly lost control. 7 people have been injured. Rescue teams, including the SDRF police and the local authorities, are currently on site conducting search and rescue operations. The Dragon spacecraft carrying Group Captain Shubhanshu Shukla and 3 others is set to dock with the International Space Station around 4:30 p.m. IST after a 28-hour journey. Shukla has now become only the second Indian to travel to space. He lifted off on Wednesday as part of Axiom 4 mission. The crew will spend the next 2 weeks on the ISS conducting scientific research and participating in the outreach activities. Former US President US President Trump has taken aim at New York mayoral candidate Zoran Mamdani, calling him a 100% communist lunatic after his win in the Democratic primary. In a post on Truth Social, Trump claimed that Democrats have crossed the line by supporting Mamdani. He also mocked the candidate's appearance and voice. Mamdani is now set to contest the mayoral race in November. If elected, he would become New York's first Indian American Muslim mayor. 12 people were killed and around 20 others injured after gunmen opened fire at the street celebration in Mexico's Guanajuato state. The attack happened during a St. John the Baptist festival where people were dancing and drinking in the street. President called the attack tragic and said that an investigation is also underway. US President Donald Trump has said that US and Iran might sign an agreement on Tehran's nuclear program when both sides meet for talks next week. However, he added that such a deal may not be necessary. This comes after Trump announced a ceasefire between Israel and Iran, saying that the conflict was effectively over. He also claimed Iran is unlikely to pursue nuclear weapons, but the US would still seek assurances during the upcoming talks. And in some other news, it's Prada that is being called a chappal chor. Yes, you heard that right. They are being accused of cultural theft after selling Kolhapuri chappals for over 1 lakh rupees, causing outrage over cultural appropriation. Well, with that, viewers, it's a wrap on Market Express. But please stay tuned to NDTV Profit as Sanjana Chauhan will be bringing you Profit 360 just after this short break.
Sambhav Steel Tubes Limited now proposes an initial public offering of its equity shares. The 100% book built offer is being offered at a price band of rupees 77 to rupees 82 per equity share of face value of rupees 10 each. Offer opens on Wednesday, June 25th, 2025. Offer closes on Friday, June 27th, 2025. For risk involved and other details, please refer to the Red Herring Prospectus dated June 19th, 2025, which is available on the website of the company, the SEBI, the BRLMs and the stock exchanges.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
The markets move fast.
And so should your portfolio.
Nifty trades above the 25,500 mark, gaining more than 1% of the day. Benchmark indices outperform broader market indices. Nifty Metal becomes the top gaining sector, gaining more than 2% for the day. In a significant breakthrough, the Aircraft Accident Investigation Bureau successfully recovers the crash protection module and the memory module from the Air India wreckage. Investigators have now downloaded all critical data, bringing the probe into the tragic air crash one step closer to conclusion. The SpaceX spacecraft carrying Shukla and 3 crewmates continues its journey towards the International Space Station. Reflecting on the liftoff, Shukla said, "What a ride it was." Sending a stern message to India's neighbors, Defence Minister Rajnath Singh refuses to sign a joint statement at the Shanghai Cooperation Organization meet because it did not mention the Pahalgam terror attack and did not reflect India's strong position on terror. India's largest lender, SBI, is set to raise up to 25,000 crore through a qualified institutional placement, marking its first equity sale since 2017. An NDTV Profit exclusive, Jaiprakash Associates draws significant interest as 6 major players, including Adani and Vedanta, submit bids in the insolvency process. Aditya Birla Capital's digital arm suffers a major cyber attack on June 9th when a hacker breached its ABCD app and illegally sold digital gold worth approximately 1.95 crore from 435 customer accounts. Good evening, you're watching Profit 360 on NDTV Profit. I'm Sanjana. Along the next half an hour, we're going to bring you the latest on markets as well as national and international news. So let's dive right into it and have a look at how the markets have fared today. The market continued its upward momentum with the Nifty crossing the 25,500 mark and gaining over 1% in a strong display of investor confidence. Now, this marks the third consecutive day of gains for both the Nifty and Sensex, underscoring a sustained bullish trend. Let's go over to Puneet for more.
Well, it was a stellar session for trading today with the Nifty 50 ending more than 25,500, and it's been a level that's evaded us for a long time, but we've finally broken through very meaningfully above the 25,200 level, ending at 25,529. It's up 1.13% today. Now, the Nifty and the Sensex has gained for the third consecutive day, and the bullish momentum has followed through as well. While the broader market indices have also been outperformed today by the benchmarks, we've seen stocks like Shriram Finance and Jio Financial being the top Nifty gainers today. We've also seen the Nifty Metal being the leading sector in terms of gains today, and that's happening more than 2% of gains seen on the Nifty Metal. Within the Nifty Metal though, we've seen stocks such as Hindustan Copper as well as SAIL being one of the biggest gainers there as well. When you look at some of the other sectors, the Nifty Bank as well as Nifty Financial and the Nifty Oil and Gas, these three sector indices were gaining the highest after Nifty Metal as well. We've also seen roughly about 2.3 lakh crore in terms of market cap being added by the Nifty companies itself. So the benchmarks definitely leading the way today. 39 out of the 50 Nifty stocks ended in the green, resultant of the strong outperformance of the benchmark indices. When you look at the other broader spectrum of the market as well, roughly 68 stocks have hit a 52-week high on the NSE today. We've also seen 76 stocks hit an upper circuit on the National Stock Exchange. Finally, we've seen, in terms of Nifty Bank, that is another one that's hit a record high, and we also spoke to brokerages like HDFC who are bullish on PSU banks, and that momentum seems to have finally come in the banking stocks as well. We've seen NBFCs as well as gold finance stocks outperform, but finally some positive momentum on the banks as well. So overall, a really strong session for the market. It'll be important that the July series gets started in a very positive way with the expiry ending for June today.
Meanwhile, Nilesh Shah, founder of Envision Capital, remains optimistic about the long-term prospects of the defence and railway sectors, highlighting their potential for sustained growth over the next decade. However, he cautions that the recent surge in defence stocks may take a breather in the near term. Shah believes that the sector's fundamentals support a multi-year growth story, making it attractive for patient investors. Let's listen in for his detailed perspective.
Well, for the very short term, the defense rally, one could basically argue that it's done with because there's been a sharp up move. So to that extent, and yet, yes, there's been the start of order inflows, but it's not yet as much to basically warrant the valuations in the very short term. A lot of stocks are already beginning to trade between 50 to 100 times trailing earnings. So to that extent, and then there's been a sharp up move of between 50% to 100% from the lows that we saw in February, March. So probably in the very short term, it seems to be done. But clearly, I would think of defense being more a decadal story. I think the whole need to kind of spend on defense and then to kind of back that up with a huge bout of indigenization, which means to procure locally from domestic firms. I think that's basically a very, very long-term growth driver for our defense and aerospace companies. So I would probably think that it's become now, yes, for the very short term, you could say it's done. But I believe defense is now becoming more a buy on dips kind of a sector.
A major breakthrough in the Air India Ahmedabad crash investigation. The government has announced that data from both black boxes of AI-171, the cockpit voice recorder and the flight data recorder have been successfully recovered and downloaded. The black boxes, which were retrieved from the crash site under tight security and transported to the AAIB lab in Delhi, contain the crucial crash protection module and memory modules. Data extraction was completed by June 25th, and analysis is now underway to reconstruct the sequence of events and identify contributing factors behind the tragedy. Now, this marks a significant step forward in the probe, with experts from the Aircraft Accident Investigation Bureau and the US National Transportation Safety Board leading the efforts. Joining us now with more details is my colleague and NDTV's executive editor Vishnu Som, who closely tracks the aviation sector. Vishnu, over to you.
there are 2 black boxes in this aircraft. Each black box has 2 components, the cockpit voice recorder and the flight data recorder. Data from the cockpit voice recorders, both of them, and the flight data recorders, both of them, were recovered from the crash site. The black boxes were brought from Ahmedabad to Delhi by an Indian Air Force aircraft with full security on the 24th of June 2025. The front black box arrived at the Accident Investigation Board's laboratory, Delhi, at 2 p.m. on the 24th of June, so a couple of days back. The rear black box, one was positioned, remember, the black box in the front of the aircraft, one at the rear section of the tail section of the aircraft, that was brought also on the 24th of June. The current status and data extraction status is that on the evening of the 24th of June, the team led by the Director General Accident Investigation Board, along with technical members of the National Transport Safety Board, which is the American investigator, the American regulator, they began the data extraction process. The crash protection module from the front black box was safely retrieved. Like, that is the crucial part of the black box. It is inside that data actually exists. The memory module was successfully accessed. Data has been downloaded, and this is the big breaking news. Data has been downloaded of the black boxes in this crash. The analysis of the cockpit voice recorder and the flight data recorder is underway. These efforts aim to reconstruct the sequence of events leading to the accident and identify contributing factors to enhance aviation safety and prevent future occurrence. All actions have been taken in full compliance with domestic laws and international obligations in a time-bound manner. Now, I was inquiring through my sources on when a preliminary report would be out. As I understand it, a preliminary report into this crash needs to take place within a period of 1 month. That time period hasn't happened, but with the recovery of this data successfully, and given the fact that at least one of the black boxes was very badly damaged, given the fact that you have recovered the data, the process of reconstruction can start. And I think in a finite period of time, there would be a report, a preliminary one, which can actually give people around the world, not just in India, that basic explanation, what went wrong.
Thanks so much for that, Vishnu, and we'll continue to track this story as we wait for that data to actually be retrieved and take us one step closer to the conclusion. Moving on to what's happening in space, Indian astronaut Shubhanshu Shukla is on the verge of making history as he prepares to become the first Indian to step aboard the International Space Station. The SpaceX Dragon spacecraft, launched by the Falcon 9 rocket, is currently en route to dock with the ISS's Harmony module. All systems are functioning flawlessly, with docking expected in approximately 20 minutes. Serving as the pilot for the Axiom 4 mission, Shukla sent a heartfelt message back home. Namaskar from space, and he expressed deep gratitude to everyone who supported him, especially his family, describing this achievement as a shared milestone in India's remarkable space journey. Let's listen in for all of the updates.
Namaskar from space. I'm thrilled to be here with my fellow astronauts, as Peggy said, 1 veteran and 3 rookies, and wow, what a ride it was. Frankly, when I was sitting in the capsule in Grace yesterday on the launch pad, my only thought in my mind was that let's just go. After 30 days of quarantine, it was a feeling that I just wanted to go. Excitement and all was, probably far away. It was just the feeling that let's just leave here. But when the ride started, it was something like you getting pushed back into the seat. It was an amazing ride. And then suddenly, nothing. Everything silenced, and you were just floating. You unbuckle, and you were just floating in the silence of vacuum. It was an amazing feeling. I wanted to take this opportunity to thank everyone who has been a part of this. I understand that this is not a personal accomplishment. It is a collective achievement of each and every one of you who has been a part of this journey.
That's right, 20 minutes more and we hope to see this historic landing. Moving on to what's happening in China. In a very decisive move at the Shanghai Cooperation Organization Summit, Defense Minister Rajnath Singh refused to endorse the joint statement, citing its failure to mention the recent Pahalgam terror attack that claimed 26 innocent lives. The draft statement also included references to Balochistan, indirectly accusing India of fomenting unrest, an allegation New Delhi strongly rejects. Let's go now across to Shiv Aroor, Senior Managing Editor of NDTV, for more insights on this developing story.
This is the strongest possible message that the defense minister has sent out in the presence of the other defense ministers of the Shanghai Cooperation Organization, which includes the Chinese, the Russian, and especially the Pakistani defense minister there, by refusing to sign a document where an attempt was made by the SCO to remove any mention of Pahalgam and to add Balochistan is a huge move by India. Remember, as a member of the Shanghai Cooperation Organization, anti-terror, counter-terror, condemnation of terrorist acts is one of the principal resolutions and motivations of this entire setup. And for them to try and remove Pahalgam and add Balochistan is a very big slight. So Rajnath Singh refusing to sign that document is a huge deal. But in the presence of the Chinese and Pakistani defense ministers, to propound the theory that has been set in stone after Operation Sindoor, that acts of terror are seen as acts of war, is a huge message that India has sent out. Remember, India has just completed a large diplomatic outreach to the rest of the world regarding Operation Sindoor, trying to convince the world in many ways that Pakistan-sponsored terror continues to be the biggest global national security threat. And therefore, what Rajnath Singh has basically done at the SCO is action that can be considered extreme. There is a huge call about why India is even part of the Shanghai Cooperation Organization if the organization itself, which is headed by China, is looking to actually remove any mention of Pahalgam. The relationship and the nexus between China and Pakistan is a very well-known one, but this kind of brazen attempt to dilute terror against India is being seen very seriously.
Moving on to an NDTV Profit exclusive, Jaiprakash Associates has drawn significant interest as 6 major players, including Adani and Vedanta, have submitted bids in the ongoing insolvency process. My colleague Vishwanath, who broke the story, joining us now with more details.
So Jaiprakash Associates has found 6 financial bidders who are interested in buying the company. These include Adani Group, Dalmia Bharat, Vedanta, Jindal Steel and Power, PNC Infratech, as well as Suraksha Asset Reconstruction Company. Going ahead, of course, this is going to be an interesting case considering that these bidders are showing this much interest, but going ahead, the lenders are going to review these bids in the next couple of days. They will then decide whether to go ahead with this entire process or not. Remember that for Jaiprakash Associates, there is an entire ruling that has come in which allows the lenders to split the separate assets of this company and sell it to individual bidders if they intend to do so. The assets within Jaiprakash Associates includes cement assets, power, real estate, hospitality. So all of these different segments could be broken up and then sold to potential bidders if lenders need it. So if they find that the current bids are too low, they're prepared to do this. That is what sources are telling NDTV Profit.
Vishwanath, also tell us the background. How did Jaiprakash Associates land in this situation in the first place?
Yeah, as far as Jaiprakash Associates is concerned, it's been a long pending case. If you know that back in 2017, actually August of 2017, the RBI had come at that point in time with 2 lists of companies which are deeply distressed, and lenders had to initiate insolvency proceedings against them. Jaiprakash Associates was part of that second list of accounts which the RBI had shortlisted. Since then, it's been nearly 8 years. Since then, lenders have been trying to initiate insolvency proceedings, but there have been multiple judicial delays that have taken place in this case. Finally, last year, the insolvency proceedings did start in Jayaprakash Associates. The creditors committee is going to review these bids that have come in. And of course, we need to see how exactly the resolution of one of the longest lasting insolvency proceedings goes on. Remember, 57,000 crore worth of dues are owed to lenders.
Thanks so much for that, Vishwanath. We'll continue tracking that story and bring you all of the developments. Moving on, India's largest lender, SBI, is set to raise 25,000 crore through a qualified institutional placement. That's its first equity fundraising in 8 years and the largest QIP share sale ever in India. SBI has appointed 6 leading investment banks, including HSBC, Citi, Kotak, Morgan Stanley, ICICI Securities, and SBI Capital Markets to manage the issue. Meanwhile, the Union Bank of India is also gearing up to raise 6,000 crore through a mix of equity and bonds to support its capital requirements. For more on both these major fundraisers, let's go over to Harsh Saita.
Well, yes. The big one is obviously SBI. It's the first equity raise they're doing in 7 years, and that's why. And it's a large raise as well. 25,000 crore, no means small. But of course, in relative terms, when you're looking at SBI's book size of 50 lakh crore nearly, it's obviously small in relative terms. But nonetheless, it's a large raise. When you're looking at the tier 1 capital of SBI at the end of Q4 FY25, it stands at around 12.11%, which is largely in line with the threshold. So this is a little bit to do with shoring up of tier 1. But when we had received commentary at the end of Q4, the management had suggested that they would do a raise as and when they see growth kicking in. And
right, Harsh, sorry to cut you off, but we quickly need to cut over to these live visuals coming in on the Axiom 4 mission that has in fact docked at the International Space Station. These are the live visuals coming in as we speak. Remember, SpaceX's Axiom mission carrying ISRO astronaut Shubhanshu Shukla has docked at the International Space Station this evening. The AX-4 crew has successfully lifted off on June 25th, space on board SpaceX's Dragon aircraft after nearly a month of delays and postponements. And aboard the spacecraft, along with Shukla, our mission specialists from Hungary, from United States, and Peggy Whitson of the United States, who is a former NASA astronaut who now works for Axiom Space. Let's remember, Shubhanshu Shukla, who is the mission pilot, is India's second astronaut going into space. Big moment for India. 4 decades after Wing Commander Rakesh Sharma made history in 1984, the 39-year-old fighter pilot was chosen by ISRO as the prime astronaut for this historic flight.
Fill that space with air to make sure that pressure is equal with the atmospheric pressures on Dragon and the International Space Station. Also putting away some hardware in the process, including the docking across. And Ayers will use a small valve on the station's hatch to slowly introduce that air into the vestibule. And flight controllers here in Houston will continue to monitor the pressure and temperature readings inside and verify that everything is A-OK and leak-free before we get ready to open up the hatches. From that capture moment, which again was 5:31 a.m. Central, 6:31 a.m. Eastern over the North Atlantic. It takes roughly about 2 hours to get everything pressurized and checked out before we open up the hatches and welcome in Axiom Mission 4 to the International Space Station.
Also, visuals that we see that are coming in of Shubhanshu Shukla's family, that is Asha Shukla, his mother. Let's remember, we had in fact seen these very heartening shots of her before the Axiom 4 spacecraft headed to the International Space Station with her son, Group Captain Shubhanshu Shukla. But now his parents, his loved ones, and all of India really awaiting the docking at the International Space Station. This is the SpaceX's Axiom 4 mission carrying ISRO astronaut Shubhanshu Shukla that has docked at the International Space Station. This is the SpaceX Crew Dragon capsule that rode atop Falcon 9 rocket
docked autonomously to the space-facing port of the ISS's Harmony module this evening. And it is carrying India's Shubhanshu Shukla along with 3 other private astronauts from Poland, the United States and Hungary, and has in fact docked at the International Space Station.
Ladies and gentlemen, it's time to keep your mobile phones ready with the flashlight.
Right, any moment now, as you heard from the announcer there, along with Shubhanshu Shukla's family and loved ones, to keep your mobile phones ready as SpaceX's Axiom 4 mission carrying ISRO astronaut Shubhanshu Shukla has docked at the International Space Station this evening. The AX-4 crew successfully lifted off on June 25th, if you remember, into space on board SpaceX's Dragon aircraft after nearly a month of delays and postponements. Now, aboard the spacecraft, along with Shukla, are mission specialists from Hungary, from United States, and from Poland, including Peggy Whitson, a former NASA astronaut who now works for the company Axiom Space, which organizes these private space flights along with other things. Now, Shukla, who is the mission pilot, is India's second astronaut going into space, 4 decades, if you remember, after Wing Commander Rakesh Sharma made history back in 1984. Shubhanshu Shukla is a 39-year-old fighter pilot and was chosen by ISRO as the prime astronaut for this historic fight. Okay, and as we all wait with bated breath for this moment, let's quickly also play out for you the message that Shubhanshu Shukla sent India and really the world just moments ago.
Namaskar from space. I'm thrilled to be here with my fellow astronauts, as Peggy said, 1 veteran and 3 rookies, and wow, what a ride it was. Frankly, when I was sitting in the capsule in Grace yesterday on the launch pad, my only thought in my mind was that let's just go. After 30 days of quarantine, it was a feeling that I just wanted to go. You know, excitement and all was, you know, probably far away. It was just the feeling that let's just leave here. But when the ride started, it was something like you getting pushed back into the seat. It was an amazing ride. And then suddenly, nothing. Everything silenced, and you were just floating. You unbuckled, and you were just floating in the silence of vacuum. It was an amazing feeling. I wanted to take this opportunity to thank everyone who has been a part of this. I understand that this is not a personal accomplishment. It is a collective achievement of each and every one of you who has been a part of this journey.
That's right, you heard from Shubhanshu Shukla, accompanied with the other astronauts from United States, from Hungary and Poland, just a few hours ago aboard the Axiom Mission 4 that was carrying all of these astronauts and is now docking at the International Space Station. What you're also seeing on screen are his family that have been waiting with bated breath for Shubhanshu Shukla to return as the Falcon 9 with Axiom 4 crew lifted off earlier.
Station copies. Dragon copies.
Communications there on the big loop between the teams here in Houston and up to the International Space Station as they troubleshoot some communications, and the big loop that you have been hearing that have connected everyone here inside of Mission Control Houston and the International Space Station Flight Control Room, those aboard the space station and inside the SpaceX Dragon Grace spacecraft, and the teams in Hawthorne, California, those 4 parties, that's the big loop. They will troubleshoot those communications for about 5 minutes and then recheck. But you heard just prior to that NASA astronauts Anne McClain and Nicole Ayers have begun the hatch opening procedures, in which the large hatch at the Node 2 Zenith, that's the space-facing side of the Harmony module, has been opened, and that will allow for them to begin the hatch opening procedures and pressurize the vestibule, which is what, in addition to the comms checks, we will monitor as Ayers will use these.
That's right. This is as Axiom 4 has in fact docked at the International Space Station. We need to slip into a short break right now, but we'll keep you posted on this and lots of other news on the other side of this very short break.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola? Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outcome
दो 2014 में 26 मई मुझे पहली बार देश के प्रधानमंत्री के रूप में शपथ लेने का अवसर मिला और तब भारत की इकोनॉमी दुनिया में 11 नंबर पर थे। हमने कोरोना से लड़ाई लड़ी, हमने पड़ोसियों से भी मुसीबतें झेली, हमने प्राकृतिक आपदा भी झेली। इन सब के बावजूद भी इतने कम समय में हम 11 नंबर की इकोनॉमी से 4 नंबर की इकोनॉमी पहुंच गए, क्योंकि हमारा ये लक्ष्य है। हम विकास चाहते हैं, हम प्रगति चाहते हैं। भारत माता की, भारत माता की।
Prime Minister Narendra Modi outlining India's incredible journey towards becoming a global economic powerhouse at the event to celebrate 20 years of Gujarat urban growth story in Gandhinagar recently.
3 नंबर पर ले जाने के लिए
And what a remarkable story of sustained economic development and growing it has been amidst all odds. It's brought the Indian economy to the global center stage. Under PM Modi's leadership, the Indian economy has taken giant strides in the global economic landscape since 2014. Driven by a series of bold and visionary reforms and ambitious policies to make India Atmanirbhar across different sectors, from manufacturing to defense, India has emerged as the fastest growing economy among major economies in the post-COVID world, especially at a time when the global economic order has been reset with geopolitical uncertainties following the Russia-Ukraine war and now the conflict in the Middle East.
The Indian economy presents a picture of strength, stability and opportunity. First, strength comes from the strong balance sheets of the 5 major sectors: corporates, banks, households, government and the external sector. Second, there is stability on all 3 fronts: price, financial and political, providing policy and economic certainty in this dynamically evolving global economic order. Third, the Indian economy offers immense opportunities to investors, both domestic and foreign, through 3 Ds: demography. We have a high proportion of the working age population which is growing. It is becoming more literate, it's becoming more educated, more skilled, urbanized. Then there is the third D, the second D, the digitalization. We have very advanced and sophisticated public digital infrastructure. And domestic demand is the third D, which we are talking about over here, which is very important given the trends of deglobalization. This 5x3x3 matrix of fundamentals provides the necessary core strength to cushion the Indian economy against global spillovers and propel it to grow at a faster pace.
The matrix of fundamentals as outlined by the RBI governor is all set to push the Indian economy further up in the global economic order. The RBI has projected that despite the risks of protracted geopolitical tensions and global trade-related uncertainties, India's real GDP growth for 2025 to 2026 is projected at 6.5%. The highest expected growth rate among all the major economies of the world. The government's think tank, Niti Aayog, has assessed that this period of high economic growth will continue over the next 2 to 3 years. Leading economist and a member of the Niti Aayog, Dr. Arvind Virmani says, this sustained high economic growth will make India the 3rd largest economy in the world by 2028.
By when do you think India can become the 3rd largest economy in the world?
So, 3rd largest economy, my projection suggests that either in 27 or 28, 2027, 28. So, overtaking Japan during 2025 and overtaking Germany, which is the next, which is now the 3rd largest, by 27 or 28, definitely by 2028.
Arvind Virmani is confident that India has the potential to catch up even with China, currently the 2nd largest global economy after the United States, if India can sustain a high GDP growth rate in the next 2.5 decades.
If we grow by in a sustained manner at around 6.3% for the next 22-25 years, we will have virtually closed the gap with China by the turn of the century, which is 2050.
In a world struggling with a slowdown and shocks following tariff-related uncertainties caused by US President Donald Trump, India's economic policies have kept the country insulated. And foremost among these policy initiatives of the Modi government has been the Atmanirbhar Bharat Abhiyan.
भारत जब समृद्ध था सोने की चिड़िया कहा जाता था, संपन्न था, तब सदा विश्व के कल्याण की राह पर ही चला। वक्त बदल गया, देश गुलामी की जंजीरों में जकड़ गया। हम विकास के लिए तरसते रहे। आज फिर भारत विकास की ओर सफलतापूर्वक कदम बढ़ा रहा है, तब भी विश्व कल्याण की राह पर अटल है। याद करिए, इस शताब्दी की शुरुआत के समय Y2K संकट आया था। भारत के टेक्नोलॉजी एक्सपर्ट्स ने दुनिया को उस संकट से निकाला था। आज हमारे पास साधन है, हमारे पास सामर्थ्य है, हमारे पास दुनिया की सबसे बेहतरीन टैलेंट है। हम बेस्ट प्रोडक्ट्स बनाएंगे, अपनी क्वालिटी और बेहतर करेंगे, सप्लाई चेन को और आधुनिक बनाएंगे। ये हम कर सकते हैं और हम जरूर करेंगे।
It was during the COVID-19 pandemic that PM Modi had given the clarion call for launching the Atmanirbhar Bharat Abhiyan. Addressing the nation on May 12, 2020, PM Modi outlined the 5 pillars of his vision for an Atmanirbhar Bharat. Prime Minister went on to lay out a 20 lakh crore economic package to kickstart the Atmanirbhar Bharat Abhiyan.
कोरोना संकट का सामना करते हुए नए संकल्प के साथ मैं आज एक विशेष आर्थिक पैकेज की घोषणा कर रहा हूं। यह आर्थिक पैकेज आत्मनिर्भर भारत अभियान, आत्मनिर्भर भारत अभियान की अहम कड़ी के तौर पर काम करेगा। साथियों, हाल में सरकार ने कोरोना संकट से जुड़ी जो आर्थिक घोषणाएं की थी, जो रिजर्व बैंक के फैसले थे और आज जिस आर्थिक पैकेज का ऐलान हो रहा है, उसे जोड़ दें तो ये करीब करीब 20 लाख करोड़ रुपए का है। 20 लाख करोड़ रुपए का है। ये पैकेज भारत की जीडीपी का करीब करीब 10% है। इन सबके जरिए देश के विभिन्न वर्गों को आर्थिक व्यवस्था की कड़ियों को 20 लाख करोड़ रुपए का संबल मिलेगा, सपोर्ट मिलेगा। 20 लाख करोड़ रुपए का ये पैकेज 2020 में देश की विकास यात्रा को 20 लाख 2020 में आत्मनिर्भर भारत अभियान को एक नई गति देगा। आत्मनिर्भर भारत के संकल्प को सिद्ध करने के लिए इस पैकेज में लैंड, लेबर, लिक्विडिटी और लॉज सभी पर बल दिया गया है।
Over the next few days after Prime Minister's address to the nation, Finance Minister Nirmala Sitharaman held a series of media interactions to outline government's roadmap to implement Prime Minister's vision of an Atmanirbhar Bharat Abhiyan. She first announced a special relief package for the MSMEs sector, which had faced the brunt of the COVID-19 lockdown.
So Atmanirbhar Bharat is what we are talking about. And you heard the Prime Minister clearly say that this is going to be resting on 5 important pillars. 5 important pillars: the economy, infrastructure, technology-driven systems, demography, and demand. So if these are the 5 pillars on which we are trying to build Atmanirbhar Bharat, the focus obviously will be what can be defined as the factors of production of, in today's language. Factors of production, all of us know that we've been hearing it: land, labor, capital and enterprise. Today we recast it, say it the same way, but then essentially referring to the very same factors of production, but in this Atmanirbhar Bharat, our focus therefore would be on those factors of production which are land, labor, liquidity and law.
The impact of the ambitious Atmanirbhar Bharat Abhiyan initiative is already visible. NDTV had visited this industrial manufacturing unit of Oriono Pro Solutions Limited within weeks after PM Modi had announced the Atmanirbhar Bharat Abhiyan on May 12, 2020. The factory owner, Sanjeev Sachdev, had then just reopened his factory just a couple of weeks after the COVID-imposed lockdown norms were eased.
On 12th May 2020, Prime Minister Modi had announced a 20 lakh crore relief package during the COVID crisis, and he had said that this is part of the larger strategy to boost Atmanirbhar Bharat Abhiyan. And as part of this initiative, the support, the fiscal support that was given to the MSME units is now producing good results.
5 years later, this MSME unit has grown manifold. Workers working with welding machines at this factory have been specially trained to produce high-end automated products. This laser-guided machine is cutting the iron sheets to manufacture different products for metro rail stations. From design to cutting, bending and fabrication of assembly firmware, most of the processes have been indigenously prepared and produced. Along with the rapid expansion of his automated product manufacturing business, Sanjeev Sachdev has now started exporting them to many countries now.
Sanjeev, in May 2020, Prime Minister had announced a 20 lakh crore package, and he said that this is linked to the larger goal of an Atmanirbhar Bharat. How far has India moved in the last 5 years?
In the last 5 years, we have travelled a distance not less than 30 years. And in another 5 years, we will cross that level to almost 100 years of our development. So, in 10 साल की journey में, हम in this 10 years of journey, which we are evolving now into a manufacturing sector, I am sure we will cover a distance what we could have done in 100 years.
These high-end automated fare gates have been manufactured for Delhi Metro, Kanpur Metro and Chennai Metro. There is also the automated ticket vending machines manufactured here, which will be installed at metro stations in Delhi, Chennai and Kanpur. These loading and unloading components and welding machines were imported from China, but now they have been locally sourced. The impact of the relief package to MSMEs in 2020 in the form of Emergency Credit Line Guarantee Scheme is evident from this data. Another significant step to establish India as a global manufacturing hub is the Modi government's production-linked incentive scheme, widely known as PLI scheme. Launched in 2020, the PLI scheme is a strategic leap towards self-reliance. Aligned with the vision of Atmanirbhar Bharat and the larger Make in India initiative. The PLI scheme has strengthened the manufacturing backbone in the country and reduced reliance on imports in industries like electronics, textiles, pharmaceuticals, and automobiles. According to the latest data released by the Ministry of Commerce and Industry, under the PLI scheme, actual investment of Rs 1.61 lakh crores has been reported till November 2024. Production or sales of around Rs 14 lakh crore up to fiscal year 2024 to 2025 has been generated. Employment of over 11.5 lakhs have been created. PLI schemes have witnessed exports surpassing Rs 5.31 lakh crore with significant contributions from sectors such as large-scale electronics manufacturing, pharmaceuticals, food processing and telecom products. More than 764 applications have been approved under PLI schemes for 14 key sectors. As the government takes the next big step towards making India a global economic powerhouse, it would require a sustained focus on the optimal utilization of India's demographic dividend, improving the learning outcomes in millions of primary and secondary schools, and the skilling of its manpower across critical sectors. Niti Aayog economist Arvind Virmani says, India will have to capitalize on the opportunity that has arisen following the growing global demand for diversification of resources of manufacturing goods. In this regard, the India-UK Free Trade Agreement finalized on May 2025 is expected to significantly boost India's export sector. According to the commerce industry, India will gain from tariff elimination on about 99% of the tariff lines, covering almost 100% of the trade value, offering huge opportunities for increase in the bilateral trade between India and the UK. India and USA are working expeditiously towards negotiating the first tranche of mutually beneficial multi-sector bilateral trade agreement by the fall of 2025. In-depth negotiations have been held in India and the US since March 2025 in areas such as market access, SPS-TBT, digital trade, customs and trade facilitation, and legal framework. Both sides are working towards achieving an expeditious conclusion of an initial tranche of the BTA. Both the countries are also working towards an interim deal ahead of the July 9 deadline, when the pause on Trump's reciprocal tariffs will be lifted. The India-US joint statement issued after Modi-Trump meeting in February 2025 has outlined a bold new goal for bilateral trade, Mission 500, aiming to more than double total bilateral trade to $500 billion by 2030. Clearly, this aggressive outreach is part of the larger goal to make India a developed nation by 2047, a goal that is sacrosanct and a reflection of the national sentiment.
एक तो हमारा लक्ष्य है 2047, हिंदुस्तान विकसित होना ही चाहिए, नो कॉम्प्रोमाइज। आजादी के 100 साल हम ऐसे ही नहीं बिताएंगे, आजादी के 100 साल ऐसे मनाएंगे कि दुनिया में विकसित भारत का झंडा फहरता होगा। अगर 25-30 करोड़ लोग संकल्पबद्ध होकर के 20 साल 25 साल के भीतर अंग्रेजों को यहां से निकाल सकते हैं, तो आने वाले 25 साल में 140 करोड़ लोग विकसित भारत बना भी सकते हैं।
In Delhi, with camera person Rakesh Singh, Himanshu Shekhar, NDTV.
One question can change everything. The big question. Bold, direct, uncompromising. Tough topics, hard-hitting analysis. Conversations that matter. We break it down, cut through the noise and set the context for you. Hear from top policy makers and thought leaders from the world of business and beyond. The big question really is, are companies using dark patterns to take you for a ride? The big question we're asking today, is the US heading towards a recession? The big question is, are we sacrificing our health at the cost of convenience? The questions you care about, asked and answered. The big question.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or
Hello and welcome to NDTV Profit. You're watching Profit Insights. I'm Hiral Datia. Joining us on the show today is a veteran investor. He's come up with an interesting book which is called, and in fact, it is a young investor's guide to wealth and happiness from here on. It's the Book of Wealth. Mark Mobius, co-founder Mobius Capital Partners, joins us to discuss more. Mark, good afternoon and welcome to the show, and a pleasure to speak to you as always, and always a pleasure to read everything that you write about. First, what has been your motivation to come up with the Book of Wealth? Because you've been writing since quite a few years, and the number of books I think I myself have read, probably a dozen out of the ones you've written. What has been your motivation on this one?
Well, I wanted to reach out to the young people, people who are graduating from high school or middle school and going into college and so forth, to write something that will give them some guidance as to how to build their wealth. And of course, one feature of the book is that I talk about health as well, because I tell people wealth is nothing without health. So you got to have both. And I talk about that in the book as well.
What has been your best learning whilst writing this book? One, from a market's perspective, and two, from a personal life perspective, because I'm sure a lot of exploring that happens as well.
Yeah, well, the key, of course, is continuous learning. Even though I've been to university, I have a PhD and so forth, it means nothing unless you continue to learn and to be interested in other things. And one of the reasons why I travel a great deal is because it gives me an opportunity to learn about what's happening in other parts of the world. So I think that is I would say, the key to being wealthy and also having a good life, learning and keeping an open mind.
Right. You mentioned about travel, Mark, and I think from 1999 to 2012, from the number of books that you've written, a couple of them you have Passport to Profit. I think you traveled extensively, if I'm not mistaken. 8 months of travel, globetrotting is where you went, and you actually were able to find the hidden market bargains overseas. From this book as well, any gems that you were able to find and give advice to investors?
Well, in the book, I outlined the different ways that you can invest, in currencies, in gold, in property, etc. I give them a menu of where you can invest. But the conclusion of all this is that equities, in other words, investing in shares of companies is the best, because companies basically are working for you. The managements of companies are working for the investor to grow their wealth. And companies in a diversified portfolio will have a very good return over a long period of time. So that is, I think, the key to having a very good portfolio, being wealthy. Of course, gold is something that I think everyone should have, physical gold. But after that, I would say it would be your own house, in other words, a place to live, to own your own house, and then equities in companies.
Thank you so much for joining us, and see you soon, Mark, for talking to us with regards to the books that you've written and the kind of opportunities you're tying for young investors with what's happening in the markets.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola? Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live. Ask, decide.
Hi, thanks so much for joining in. We're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Now, when it comes to equities, a long-standing advice that a lot of investment advisors will give you and have given you is that you need to stay the course. And I know that it sounds a little trite to say things like this, where you keep saying, keep your SIPs going, stay invested for the long term, but then often you have the opportunity to talk about data that reinforces this fact. Now, over the last couple of months, you will know that there is a high degree of geopolitical tension that has played out, not just in certain parts of the world, but also in our own backyard. And you had Operation Sindoor pan out. And what I have focused on is that there was a low point for the broader markets in April, in the start of April. And since that point, there's been a very sharp and very stark rebound. So since the low point in April to where we stand right now, the mid-cap index has gained 19.5%. And the small-cap index has gained over that. So the point is that if you had stayed invested, you would have made money if you had invested in the broader market funds. And a lot of you will have those SIPs running. But if you haven't, if you pulled out, what should your strategy be? And if you're investing for the first time, what should you bear in mind? Joining me is Mohit Gang, who's a co-founder and chief executive officer of Moneyfront, as well as Vineet Iyer, who is Managing Director and Principal Officer at Prodino Wealth. Thank you so much to the both of you for taking the time. First, the question to you, Mohit, before we get into individual schemes, is I want to understand from you what your clients spoke to you about. And of course, I'm pretty sure that you managed to convince them to stay invested. Those people that didn't and those people that pulled out, they wouldn't have had the best experience. Is this a good example, or do you think that it's too short a time frame?
Hi, morning, Alex. Always a pleasure to be speaking with you. Look, I think this is one of the classic textbook cases, and I think it should be made a case study the way last 6 months have panned out in the market. There was every bit of negative news which one could have imagined, every bit of wrong signals in the market where one would be tempted to sell, book profits and cash out, sit on cash, liquidate, and not just investors. I think the best of fund managers, Alex, have taken that call where they've sat on cash, right? Yet, in spite of the geopolitical tensions, in spite of the macros, whatever they have been done, in spite of the US tantrums and multiple myriad things which have happened across us, the markets haven't moved an inch. If you would slept, let's say at the start of the year, and you would be waking up now after whatever 6.5 months, you will realize that the world is where it was in terms of markets. It hasn't moved an inch, right? And even from April 7 lows, which we saw, the markets have rebounded astonishingly well. So anyone who was wanting to take a cash call, was wanting to sit idle, stay out of the markets, have got a bitter lesson, because you don't get those entry points in the market, Alex. You definitely get exit points at bad news and bad geopolitical events. But the rebound is so sharp. It's always a fast V-shaped recovery, which we have seen in the market, and so sharp that most of us actually can't enter back in the markets. And that's a very, very classic telling example of why investors should just stay put and avoid all the noise and clutter around the levels. And just to answer the last part, yes, our clients have all stayed put this course, and we have made sure that none of them, at least because of geopolitical reasons or the uncertainty in the market, are liquidating. If they were to liquidate, then it will always be basis their goals and asset allocation.
Vineet, coming to you, just because it has occurred in the past and just because we see similar scenarios play out repeatedly doesn't mean that the next crash will be the same or the next experience will be the same. I think this is a hard lesson for a lot of people to learn. But having said that, people still tend to keep cash, saying, I want to deploy at these levels, and they miss out, as we've pointed out. What do you advise your clients to do? Are you advising them to remain fully invested at any given point of time?
Yeah, thanks, Alex, for having me here. It's always good to be on your show. So we follow a premise of financial planning, where anything which is more than 5 years away as a goal, we recommend them to invest in the long-term equity strategy, which has, of course, allocation to mid, small, as well as the other categories. And we also tactically ensure that the mid and the small cap category does not have more than 15-20% allocation individually. So we ensure that whenever the goals are getting near, we are moving out of equity and then ensuring that those money is available in safer assets. So in case of any kind of events which is going to impact the market negatively, those things does not impact the value. And the classic example we saw was in 2020, where all of a sudden COVID came in from nowhere and the market crashed massively. The second massive crash that we saw in the last 25 years after the global financial crisis. So even then, clients were not panicked, who knew that the money that they need after 5 years, those are invested into equity. Anything which is short term is sitting safe in a hybrid fund or maybe a debt fund. So this time around also, in fact, there were a little bit of curiosity in terms of what are the things or what are the opportunities that are available, so that if people have cash, they can deploy. That's an interesting shift that I'm seeing. Plus, what we are also looking at is if people have lump sum, we are deploying that in stages over the 6 to 12 months with through the SWP SIP route. And we are kind of averaging out the purchase with a time horizon of at least 3 to ideally 5 years.
I assume that you are using STP, the systematic transfer plan route, and SIP route, correct? Because you said SWP, that's why I'm just wondering.
Yeah. So we work a little differently. Rather than having, say, 5 different schemes and then putting money from debt to equity through those 5 debt funds. We have one debt fund, and then we set up a systematic withdrawal plan. And that systematic withdrawal plan comes into the bank account, and from there we fund the SIP. So it's not directly going from scheme to scheme. It's actually going from bank account to the equity scheme.
I assume that that is something that allows you to have more flexibility in the schemes that you invest in, because you don't necessarily have to transfer from the debt fund to the scheme from the same category. Okay, so let's talk about this. This is an interesting strategy. So let's pause our conversation on mid cap and small cap just so you understand exactly what is happening here. So a lot of people utilize systematic transfer plans to transfer from a fixed income scheme of one category, of one mutual fund, to equity of the same mutual fund. That's the restriction. You can't, for example, transfer from a fixed income mutual fund, say a liquid fund of a DSP, to a Nifty 50 index fund of an ICICI Prudential mutual fund. You can't do that. You have to choose a fund of DSP. So what Vineet is suggesting is that he has a debt fund of a particular fund house. He allows the money to come into your bank account through a systematic withdrawal plan, and the bank account is then used to push money into possibly 4 or 5 schemes through an SIP route, which is quite an interesting strategy to go by. Okay, so that's insight as to how you can stagger your investments going forward. But let's talk about first the top performers in the mid-cap category. And let's pull up the top 4 odd or top 5 odd. You have ICICI Prudential, you have HSBC mid-cap, you have Invesco India mid-cap, and you have Canro Robeco mid-cap fund, which are the top 4 performers in the mid-cap category. And the outperformance is anywhere between 3.4% for Canara Robeco to about 5.9, nearly 6% for ICICI Prudential Midcap. Let's talk about what has worked, because Mohit, you have more schemes in the mid-cap category that have managed to beat the benchmark than the small-cap category. Why is that, and what has worked?
Alex, look, I think one of the stark things which we have seen from April 7 lows is that the mid-cap index has kind of bounced back by almost 19.5%, whereas there are only 4 or 5 schemes which have given considerable outperformance on the index, though there might be a total of around 8 to 10 odd schemes which have outperformed the index by a margin or a fractional point. Yet there are almost a good large majority of schemes, perhaps 16 odd schemes, which have underperformed the index. So it is a telling sign on active versus passive debate, which we can have for some other day. Having said which, the few schemes which you named, let's say an ICICI Prudential Midcap or an Invesco Midcap, an HSBC Midcap or an Canara Robeco Midcap, which are the first 4 names which have outperformed significantly. I think one of the bigger signs which I see emerging out here is they have a very, very manageable size in spite of being in the mid-cap space, right? So all ranging between 6,000 odd crore to around 10,000 odd crore kind of an AUM gives them that flexibility, gives them that maneuverability, the ability of the fund manager to move a little quickly. Unlike the large schemes, if you see all the large schemes in the mid-cap category, which are over 30,000, 50,000 crore kind of an AUM, they have significantly underperformed in this rebound, right? And perhaps they need a little bit more of pacing or portfolio designing before they can start performing like the benchmark. The second thing which I note is because of this rate cut significant movement which happened and which was 50 bips, which was unanticipated, the portfolios which were positioned to benefit more by virtue of the rate cycle reversing are the ones which have actually fiercely outperformed, right? So anyone who was positioned a little bit in non-PSU banking space, or let's say perhaps only an NBFC space in the financial services, or a little bit of rate sensitive sectors are the ones who have actually benefited the most in this rebound. So if you see few of these funds, they are a little heavy on such positioning, right? And one last point out here, there are few similarities if you see across some fund houses. So let's say if you were to pick up Invesco, for a case in point, right? Across the categories, if you see, whether it be large cap, mid cap, small cap, they have handsomely beaten the index. Sometimes the portfolio positioning is such across fund houses, Alex, or the style of investing is such that when the cycle turns, they are across the board, all their schemes benefit. So I see this happening a lot on the Invesco, Bandhan, DSP, few of these AMCs, which are now playing perhaps a mix of quality plus growth cycle. And that specific positioning in their portfolios have helped them a lot across these fund houses, if you were to notice.
Interesting points that you make. And that last point is exactly what I wanted to get from you, which is at any given point of time, there is a seasonality in the kind of strategy that tends to work and that tends to not work. And there's no unmitigated 3-year, 5-year, 7-year time frame where only one strategy will work. So you will see moments in time when your portfolio is underperforming your neighbors, and that's perfectly normal. But Vineet, there are a few parameters that you would look at. In an upcycle, when the market is doing incredibly well, you would look for schemes that have an up capture ratio that is better than everybody else's, which is you look for schemes that are doing better. And obviously the schemes in our list, which we've discussed right now and what Mohit has just spoken about, would have a better up capture ratio than everybody else. Would you focus more on the up capture ratio, or would you focus more on the down capture ratio though?
In fact, both are equally important. Of course, in a bull market, you would want the fund to give you better returns than the benchmark. And of course, when the markets are not doing well, you would want the fund to kind of have a low, lesser low than the markets. So both are equally important. I would not discount any one of them. Interestingly, if I look at, and just adding to what Mohit said, if I look at why investors kind of outperform, I see a very interesting trend over there. They have a 47% allocation to mid cap and a staggering 21% allocation to a small cap in their mid cap fund, and about 30% to large cap. So they're kind of equally distributed their funds in these three categories. And when you talk about small cap funds like Bandhan, they have been sitting on about 13% cash. And probably one of the reasons why their funds have performed well in the last 1 year is because of the cash call that they've taken. And maybe they've kind of maneuvered their portfolio in a way that when the market kind of rebounds, if they're kind of putting in that cash, they have that upside capture. And at the same time, the drawdowns are lesser for their funds.
Yeah, that's an important point that you make. Just as we're speaking about winners, we also have to speak about those strategies that have not worked and why they have not worked. And Mohit, as I look down the list, at the bottom of the list are schemes like Baroda BNP Paribas Mid-Cap Fund, you have Quant Mid-Cap Fund, and you have SBI Magnum Mid-Cap Fund, all of which have underperformed to the extent of 5% to 7.9%. Versus the benchmark, which is quite a big gap. Of course, this is only a 2-month time frame. Why has this occurred though?
Alex, I think A, you are right that it's only a 2-month time frame. B, however, the reality is that versus an index of around 19.5, 20, these funds have significantly outperformed by a margin of around 5 to 7%, right? And I think market has completely changed in its style and texture. And if you were to notice few of these schemes, specifically the quant schemes across the board, across the spectrum, it's not just the mid cap, Alex, it's also the small cap and few other categories if you were to watch. Quant was a predominantly momentum oriented theme or a momentum driven fund house, right? Most of their schemes did exceptionally well when the market was on a tearing rush on an upward direction, right? And their schemes were outperforming with a large extent, and that's where droves of investors flew into the schemes. When the market's texture broke, when the reverse cycle happened, the momentum has completely got broken. The momentum theme has lost its sheen, and hardly there are any stocks which are now working on momentum. I think the cycle has reversed a little. If you see quality funds or the fund houses which are more oriented towards quality are picking up very specifically in this cycle, and also growth oriented companies, right? So a mix of quality plus growth is something which these funds were lacking. That's my clear reading out of it. And that's kind of led to a stark underperformance. And my sense is if the cycle keeps thus for at least 6 months to a year, then perhaps these funds will again take a longish while to rebound. Having said which, no fund is a bad fund, Alex. It's just that the right cycle has to strike at the right time for the fund to deliver returns. So for investors, it's just about patience and staying put with the themes.
We'll come back to that. We'll revisit that. But I do want to talk about small caps as well, because in the small cap category, Vineet, I'm coming to you first on this one. There are far fewer outperformers. There are just two schemes that have even 0.5% or more. You have DSP small cap fund that is managed in this time frame, and I know that it's a very short time frame, but it's still a time frame where the index itself has risen by over 20%. DSP has managed to achieve a 1.4% higher return, whereas HSBC small cap has managed a 0.5% increase. Invesco has more or less matched it. And then everything below that, GM small cap, for example, is performed not as well as the benchmark, 0.5% lower. UTI also 0.5% lower, going down the list. Why is that?
I think these funds have taken a good cash call. Plus, if you look at the small cap category, it's a wide choice that the fund manager has. And stock picking ability becomes a very, very important factor when it comes to the outperformance. So I think DSP and HSBC have done well on this part. Probably the stocks that they've picked have done well, have reasonably done well in the last 2 months, and because of which you are seeing an overperformance. And if I look at the broader index as well, the small cap 250 index, it's trading from a long-term median PE. If you look at the discounting, it's just 3.85% of discount that it is trading at. So, which means that there are pockets in the index in terms of securities where you have opportunities where it's kind of undervalued, probably out of flavor, because of which if the fund manager takes a stance and if that flavor works out, if liquidity gets created in those stocks, of course there's an upside. So I feel that these two factors have helped these two funds to kind of outbeat the benchmark and of course outbeat the other peer group in their category.
Okay. Mohit, you want to come in on why so many schemes in the category have underperformed? And of course, I buy the argument, the fact that small cap funds, because of the universe available, it's difficult to build a portfolio, and therefore beating the benchmark is something that star fund managers are able to do. Why is it that they've not been able to do it in such a broad-based rally?
Look, Alex, it's actually very surprising to me because small cap as a category has huge choice to offer compared to the other two categories, right? And out there, typically the whole premise, which we've been often debating, is that the fund managers should be able, along with their experience and significant reading of market, they should be able to beat the benchmark. Having said which, 2 months is perhaps a little low threshold for us to evaluate. However, not a large majority of fund managers underperforming is actually concerning, honestly. And by virtue of if your portfolio was a little index hugging, or if your portfolio was tilted towards those high PE stocks or very expensive stocks or stories which were predominantly available, let's say last year, and if you haven't been able to change the texture of your portfolio very quickly, right, then I think those are the portfolios which have suffered significantly in this last 2 months of rebound. If you see the top performing portfolios, let's say if you were to evaluate DSP per se, Vineet Sambre obviously has been managing that fund as a CIO now. He overlooks everything along with Resham Jain. But the fund was extremely heavyweight on consumer discretionary as a sector, and then materials, which if you see all the other funds, they aren't so heavy, barring 1 or 2 funds which have actually done very well, perhaps a Bandhan or something else, have consumer discretionary as a significant overweight exposure in their portfolios. And I think that's where the reading has gone right, and they've been able to significantly outperform. Again, we have to understand small cap as a category does not offer too many choices in the financial space. So the fund managers are a little constrained as to what to pick up out there, unless they pick it up as part of their large cap allocation or something. So trying to play the small cap within what is available in that space, and they're finding rate sensitives and finding something which will play out once the cycle turns, along with a good growth prospects. I think that's what has led to these 1 or 2 funds giving us a positive return.
Okay. Vineet, comment about the number of holdings in these small cap funds. And I have asked this question specifically about Nippon India Small Cap Fund in the past. I mean, they've managed an outperformance over long periods of time, but I'm seeing that number tick up as the weeks go by. It's now at 240. And you have a few others that have a significant number of shares, like Bandhan Small Cap, for example, that has 190. You have Axis Small Cap that has 135. But by far and away, Nippon India now has the most stocks in the small cap category. Of course, it is holding the largest assets under management by far. But is that something that you pay attention to?
See, it could, I mean, it's actually in a way better for a fund to have too many holdings. There could be some management challenges there. But from a liquidity standpoint, and if the fund size is getting larger, if you're not getting adequate opportunities in the existing securities, you want to kind of diversify further. And that actually creates a long tail. So whenever we were speaking to, in fact, this was one of the concerns in some of the quarterly researches that we did. And when we reached out to the team, we got to know as an understanding that it's a purposely driven thing just to maintain liquidity, because if there is any sudden drawdown, they have enough securities that they can kind of liquidate and create those liquidity for kind of maintaining the redemptions. And in fact, if you look at some of the other category funds like Parag Parikh, FlexiCap, even they have started having large number of holdings, being one of the largest in the FlexiCap category. So I think as and when the fund grows in size, there is popular demand and the investment manager is not finding decent opportunities, the tail would go up. So there could be an inflection point where if it becomes too much to kind of manage, so we need to kind of wait and see. But at this point in time, I think look at the universe, 240 is still not a very, very huge number. I think we're good.
All right. So let's talk about what an investor should do if they are looking to invest for the first time. And we have a certain set of data. Of course, I'm stressing again, this is only 2 months. And so therefore, the outperformers in this 2 months should not necessarily automatically find it into your buying list. Mohit, I'll start with you. What advice would you give in the mid-cap and the small-cap category?
Alex, look, I've always been very clear. One has to have a mix of active versus passive in all the categories which one is investing in. And I would go with a mix of one active, one passive in both the categories, just to get a full flavor of what the index is doing. It could be a factor-based index. If you are really keen on it, then I think that's a great strategy to have, or it could be a plain vanilla index. And one active fund which you really believe in, where you kind of resonate with the fund manager's objectives and the philosophy, and then you stick with it. Don't just try and change your small and mid-cap allocations basis 6 months of performance, underperformance or overperformance, because every fund will get its cycle, will get its day in the sun. And I think one has to patiently wait for that day. When it comes, they really come very, very hard with performance. So one has to just...
Yeah, you know, to reinforce that, sometime next week, what we'll do is we'll pull up the worst performers of 2025, or maybe at some point in 2025, and we'll pull up the list of worst performers over the course of the last 1 year. And you will notice that there's a very stark difference between the two, even though it's a pretty short time frame. Vineet, last comments for you. Advice, similar question to what I asked Mohit.
Yeah, so I think in the mid and the small cap, actively managed funds has a very good chance of kind of outperforming over a longer period of time. And I was reviewing some data for the past 1 to 2 years, and I see that majority of the, at least the top 10 category funds have outbeaten the index by quite a margin. Some funds have beaten in excess of 5%. So I would still stick with the actively managed funds in the mid and the small cap space. Probably in the large cap space, I might go with a active passive kind of this thing, because I feel that even today in mid cap and small cap, it's a stock picking ability that actually derives the performances. Probably 10 years down the line, those options may not be there, and that point in time probably like a mixed strategy of active passive would work well.
Okay, fair enough. A very quick last question to both of you. I'm not asking for recommendations, but what's on your short list in both the mid cap and the small cap category? Vineet, first you.
So we are sticking with Kotak Emerging in the mid-cap category, and in the small cap, we're still sticking with Nippon being the largest fund. And since they have been having the experience of managing this since more than 20 years now, so we want to kind of stay with someone who has the ability to kind of stretch through the difficult times. So these are the topics in the category.
Mohit, what about you?
For me, in the mid-cap category, Alex, it's the quality factor. DSP mid-cap 150 quality 50 index fund. And in the active, I'd go with an Invesco mid-cap. In the small cap, we've been sticking around with Bandhan small cap for a while. And if someone is really keen, then we also go with a passive choice in the small cap.
Fantastic. Okay. All right. Gentlemen, thank you so much for joining me on this edition of Your Money Matters. It's been an absolute pleasure speaking with you. And viewers, that brings us to the end of this edition. As I pointed out, do let us know what you think in the comment section and stay tuned. Lots more coming up on NDTV Profit.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola? Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Imports become the exception rather than the norm, and increasingly we do almost.
Now, one of the things that's taken grip and center stage this week is the IPOs, and within that IPO frenzy there is HDB Financial. Welcome, you're watching KYC. I'm Harsh Saita, and today we're going to focus in on HDB Financial. 3 or 4 parameters that really pique interest with regard to an HDB. One of them being the fact that it's owned 74% post this IPO by an HDFC bank. But what you want to see is whether there is a real large risk of that holding coming down to 20%, because that's what the RBI draft norms are pushing NBFCs to do. And within all of this, of course, is the fact as to whether you should subscribe to the IPO or not. And we'll get some insights from analysts on this entire RBI issue possibly, which could come up. with regard to an HDB. RBI in a very different mood and therefore may not materialize as well as a risk, but we'll understand that risk better. The second piece is the interplay between growth and valuations. It's a decently fast growing company. And the IPO valuation is something that we'll highlight, compute and give you a deep dive on as to how you should look at. And we'll also ask analysts, one of the analysts who we're speaking with today, as to how he looks at both the price to book valuation as well as the 1 year forward and maybe the next 3 years that he sees with regard to this one. The promoter ownership shrinking, that's the third risk which I'm talking about, and we spoke a little bit about that risk. It'll come straight up on your screen. There you go. And whether this business is highly cyclical, how should we look at the business? Because you have HDFC Bank on the one hand with a very stable lending business trading at 2.5 times price to book. And then you have this business. Is it slightly chunkier? Is there a risk and high level of cyclicality within this, or can that cyclicality stabilize? And yes, in the good years, will it be extremely good? And in the bad years, can it maintain status quo? Even a 2% ROA is not bad in a bad year. And that's what I want to understand better. And fifth point being, can it sustainably continue to generate profits? I want to pull out one nugget. In the last 8 years, HDB Financial has not done a fresh equity raise even once. So from its loan book size of 35,000 crore to the current loan book size of 1,06,000 crore, it's not done one fresh equity raise other than ESOPs, of course, which is a big thumbs up, right? There you go. So what you want to actually understand is whether this profitability can sustain going forward as well. Again, even in the IPO dilution, it's a small dilution that they are doing with regard to fresh issue. It kind of raises the question that sustainably, our ROE ratio is just significantly strong to take care of growth. And, you know, we'll try and dissect some of those angles as part of KYC today. Let's though first off start by understanding what HDB Financial actually does. Let's start from scratch. Let's pull out the RHP. For those who haven't read it, let's pull out the RHP and do a little bit of reading. Well, it was incorporated in 2007. It's a retail-focused NBFC. So while at its core, it's not retail like a Bajaj Finance, but it does lend to individuals and small businesses. And that's why that granularity is what causes it to be called a retail-focused NBFC. And it's the 7th largest retail-focused NBFC in the country. It covers around 1,170 towns and cities. It's spread across 31 states and union territories. So even in terms of the diversity in terms of geography is very, very large, right? Which causes more granularity. It also brings in an element of stability, because no one region impacts the book as a whole. It has 1.92 crore customers. This has gone up from 1.2 crore customers in FY23. So just look at the growth in the customer count, which is getting added in the last 2 years alone, is nearly 60 lakh customers. So 50% of all its customers combined since 2007. 50% of that, or rather 30% of that, 33% of that, it's done in the last 2 years alone. That just goes on to show that the scale is starting to pick up. It has over 1770 branches and has an average ticket size of its loan is around 1.65 lakh. This shows how granular the loan book is. In fact, when I was reading through, the top 20 borrowers comprised less than 1/3% of the cumulative book of the NBFC. That kind of shows how granular it is. Now let's talk a little bit about what's unique with regard to HDB. I've already spoken a few things about what's unique, but let's talk about this, the macro factors that's unique. 80% of the branches are located outside of India's 20 largest cities. Over 70% are located in Tier 4 plus towns. I also want to talk about how it's more focused to underserved and underbanked customers. That's the larger focus. And the low to middle income households with minimum or no credit history is what they cater to. In terms of a little bit more on that low to middle income households with no credit history. Around 12% of the loans are to people or persons with absolutely no credit history. You want to take note of that number because that also presents its set of risks, but it also lends to the fact that if they have been doing this for so many years, they've got some formula right, and therefore you want to look and pick as to whether that's a risk worth taking or not. But that's broadly what you should know. Let's talk about the business now. It's obviously into lending. Let's talk about enterprise lending. That constitutes around 40% of the book. Business loans, LAP, gold loan, and salaried personal loan. These are the constituents of enterprise lending that they do. Let's talk about asset financing. Again, around 38% of the book. Tractor, CV, and CE loans is what it caters to. And then there is consumer finance, and there are a whole bunch of consumer finance loans that they give, which contributes around 23% of the book. Asset finance is fully secured, and 73% of the loan book along with it is absolutely fully secured. Of course, in case of a default, there are certain processes which kick in and take time to kind of liquidate assets, but it lends some amount of comfort to the way in which the loan book shapes up. Let's look at the metrics that we look for in an HDB financial. We start off with the income statement, balance sheet. We look at key metrics individually, which includes yields, margins, ROA, cost to income. We'll also look at the asset quality of the financier. We'll look at shareholding pattern, valuations, and we'll look at risks. This is slightly different because street coverage is not something we have. So again, that is a key component. Let's quickly look at the income statement. You look at the net interest income growth. It's been at roughly 17% odd over the last 2-year CAGR. The operating profit has grown at a 41% CAGR. They're also doing, mind you, they also do back office services for an HDFC bank. So that contributes to the other income line and the other services that they provide. Provisions has in fact gone up in FY25, and that's why you're seeing that CAGR number quite high. Profit is up just about 5% due to the higher credit costs that we've seen, and therefore any tapering down on the credit cost could well aid profitability if that were to happen, and any increase in the credit cost could cause cyclicality to profitability. This is a risk we've spoken about. We've given this a neutral because of exactly and precisely that reason. Let's now talk about the balance sheet and look at the way in which that one has grown. Last 2-year CAGR has been 24%, 3-year CAGR has been 20%. So decent growth on the balance sheet front. Borrowings is up around 26 odd percent. When you're also looking at the capital adequacy, it's very, very healthy. Mind you, you want to note those 2 points that I spoke at the start. The first point being that in the last 8 years, they've not done a single equity raise. Extremely solid, and profitability is basically what is driving growth here. And the second piece, of course, of that is that in the meantime, your gross loan book has gone up from 35,000 crore to 1,06,000 crore. So growth has been extremely strong as well in those years. But a 20% 3-year growth is not bad at all. We'll give this a thumbs up with a 19% capital adequacy. Again, not looking bad. Let's look at the key metrics now very quickly. Yields are at 14 odd percent. You see your cost of borrowing is roughly 7.9% for FY25. So again, that is not bad, and it gets advantage with regard to cost of borrowing because it's the subsidiary of an HDFC bank, and that kind of gives it a little bit of leverage in terms of cost of borrowing versus its peers, even within the same risk bracket. When you're looking at margins, they've come off slightly, but that's how the rate cycle has also progressed. With this rate cutting cycle starting, it could well aid margins as well going forward. Look at ROAs. ROAs have come off in this year, and that is because you've seen some bit of credit cost spike which has happened, and therefore that is playing out on the ROA number. But look at how cost to income has evolved as a result. Credit costs increasing, they've tapered down on their cost to income. 49% is where that cost to income currently lies, which is also elevated. But nonetheless, this looks like a decent set. 2+% ROA in a tough cycle is not bad. 3% roughly in a decently okay cycle is again very, very creditable, and therefore we've given this a thumbs up overall. Let's look at asset quality metrics. Your NPA ratios have come off but have bounced back up in FY25. We spoke about this. And your net NPA too has bounced back up. This will see cyclicality on a year-on-year basis, and it will depend on how the business and the credit cycle is evolving, and therefore we've given this a neutral. But it's fairly controlled. Given the kind of borrowing or lending that it does, this is not a bad net NPA ratio to have, which is sub 1%. So they're providing well with regard to their NPAs. Let's talk about shareholding now very quickly. You're looking at promoter holding, which is at 94% currently, expected to fall to 74%. Right? Now the real risk here is if RBI's draft norms are implemented and this promoter holding is mandated to fall to 20%. Two reasons why this will happen. One is if there is no distinction or distinct lending, which HDB Financial does versus an HDFC bank, it's a very real risk. They've carved out this risk. So you want to keep your eye out on that. The second is, of course, if they continue to hold HDB Financial and don't merge it into the bank, that these two could well translate. And of course, if the draft guidelines are made final in its current state, these are key risks with regard to shareholding pattern as well. And hence, we've given this a neutral. You want to wait and watch how this one evolves. This is a key risk for every holder of the stock. Vishy joining me as well. Vishy, any thoughts on this piece?
Yeah, so as what you were mentioning earlier, that there are certain risks that are inherent, Harsh, to this kind of business, especially the point that you made about the subsidiary guidelines of the RBI. Now, that is a bit of a roadblock especially as far as HDB Financial is concerned, because HDFC Bank owns the majority stake, currently 94%, post this issue about 72% that they're going to hold in the NBFC. And if the businesses are not materially different, then it becomes a real choke point. But of course, it is incumbent then upon the management of the NBFC to convince the regulator that, yes, they are similar umbrellas, but we are entirely two different entities doing supporting two different types of clientele. Remember that was what is the RBI's major concern, that you don't want the same group to lend to the same entity through multiple lending arms. So that is something that the RBI wants to avoid. And if they're able to convince the RBI that this is how the businesses function, then things might look a little bit better.
Right. So that's with regard to the shareholding pattern, something you should keep an keen eye out on. Let me look at valuations now. It's currently trading at the list price to the book value, or the IPO price to the book value, not the list price. The IPO price to the book value is 3.7 times. But that's not the right way to look at it. You have to look at the book value post the equity infusion. And the book value post the equity infusion is 3.33 times. That is the current book value post equity infusion. This, on a 1 year forward basis, could well be 3 times. And I'm assuming that last year's profit after tax will continue in FY26 as well. That's a conservative estimate. A lot of analysts on the street are estimating a slightly better 1 year forward price to book, but we've been conservative here. Doesn't look particularly expensive, but doesn't look particularly cheap either, and therefore we've given this a neutral, Vishy. And the last piece is with regard to risks. Now, we spoke about at length about how the promoter may be required to substantially reduce ownership to less than 20%. Seasonality, which impacts the business, we've spoken about this. Non-payment or default by customers. A lot of these risks are also highlighted in the RHP. So if you do have the bandwidth, please do read the RHP before you subscribe. But even if not, we've covered the key risks here. So it kind of gives you a good lens. Also, secured loan defaults will likely lead to risks to enforcing collateral, which has its own set of procedures and practices. Offer for sale is 10,000 crore, which is a large chunk of the IPO. Conflict of interest with HDFC Bank, of course, both lend to, or rather are lenders in itself. Trademark and license agreement is present with HDFC Bank. Volatility in interest rates impacts the numbers, and competition, of course, is starting to rise again in some of the pockets where HDB Financial lends to. Last off, I want to also talk about how the street is looking at this. All analysts have an apply on this one. Let's quickly stack up all the ratings, and that gives us overall a 5.5 out of 8 on our KYC ratings. We'll have that on the screen in just a minute. There you go. So that's the rating on KYC. Let's go across to Shripal Doshi. He's joining us, research analyst, NBFCs and SFBs at Equirus Securities. Shripal, great having you. Apologies for the slight delay that we've seen. Let me start off by asking you, how do you look at the risk of HDB Financial having to go through multiple cycles? Because the ROA cyclicality is evident. So how should one view that?
So, good morning, Harsh, and thanks for having me. So with respect to the volatility in the ROA, it's a function of the product mix also, if you look at it from that angle. They have a product portfolio which is across 13 subsegments, right? So while you have highlighted the 3 key categories, but then within that there are 13 products, and those products have gone through turbulent times, let's say post-COVID twice. So in FY21-22 was a period wherein those product segments led to higher credit costs, not only for HDB per se, but at system level as well. And then also in FY25, we've seen that trend, let's say in segments like CV, in segments like personal loans, some of the retail loans. So therefore, the volatility in the credit cost leading to volatility in the ROA. However, if you look at it from the diversification point of view, it is still a very, very well diversified franchise, decoupling itself from one particular segment and the turbulence in that particular segment. So while there is volatility, it is the best probably in terms of diversification that a franchise can have to sort of decouple itself from these credit cycles or credit cost cycles.
Well, Vishwanath here. I just wanted to join in this conversation and ask you a couple of questions, specifically around the OFS bit. Now, HDFC Bank is going to offload shares worth 10,000 crore. Now, that's the stated goal that the bank has stated. Obviously, that will bring down a shareholding. Do you at any level see it as a material risk that the promoter is offloading a sizable chunk? And out of the 12,500 crore, this is a big part of this entire issue.
So see, this is also with respect to bringing shareholding to, let's say, below 75%, right? Which is one of the requirements by the SEBI. So it is in sync with that, and I do not see so far any risk of this shareholding coming down to 75% or 74%, being very specific there. So I do not see any risk there because it continues to enjoy the AAA rating on the credit rating side, right? By most of the credit rating agencies. So bringing it down to 74% doesn't really have any impact on the credit rating or on any other operational aspect of the franchise.
Shripal, can they in some way circumvent the RBI regulation? And I'm assuming that this regulation becomes final, can they circumvent it by saying that they're doing a different business, it's a different cohort, a different set of clients that they handle?
So see, they are into different customer target segment actually, while the product portfolio is an overlapping product portfolio, or rather because they're into diversified product segments, right? But the kind of customer segment that HDB caters to is broadly different, or let's say relatively inferior versus where HDFC Bank is sort of positioned. And to your particular question on draft circular and its implication, so see, we'll have to wait and watch how the RBI comes out with the final version of that circular, because if they require the shareholding to sort of get trimmed down to a particular percentage, that could have an implication on how credit rating agencies look at these NBFCs at large. I mean, I would not only keep or contain myself for HDB, but also for some of the other bank-backed NBFCs such as Canfin Homes or let's say Fed Bank Financial Services or PNB Housing. So that will impact all of these guys from where the credit rating agencies look at these NBFCs, and that can have some impact on their cost of fund or their ability to raise funds at a lower rate from some of the banks or some of the financial institutions.